Ladies and gentlemen, we are starting our session 1. I request you all to kindly take seat. I request you all to please take seat and also clear the passage near the dais. We are starting our session 1. Okay. We now move to our CEO panel discussion on the topic Banking for a Viksit Bharat. It's my pleasure to invite on dais the panel of speakers. Mr. M.V. Rao, Chairman IBA and MD and CEO Central Bank of India. Mr. C.S. Shetty, Chairman SBI. Mr. Devadatta Chand, MD and CEO Bank of Baroda. Mr. V. Vaidyanathan, MD and CEO IDFC First Bank. Madam Zareen Daruwala, CEO Standard Chartered Bank. Mr. Hitendra Dave, CEO HSBC Bank. And our moderator for this session is Mr. Ruchin Goyal, MD and Senior Partner BCG. I request you all to please take seat. I request you all to please take seat as we are starting our first panel discussion.
Check. Thank you. Can we start?
He's coming in 5 minutes.
5 minutes.
Should we start?
Let's start.
I request Mr. Ruchin to initiate the discussion. Over to you, sir.
Good afternoon, everyone. Can I please request everyone to please take their seats? I know we've had some good sessions in the morning. Mr. Rao. So if I can just request everyone to, he's coming in 2 minutes. All right, so we will start the first panel discussion of FIBAC 2024. I have a very, esteemed set of panel members. I don't think any one of them need any introduction. Mr. Rao is just, outside escorting the secretary out, so he'll be joining us in a couple of minutes, but we'll start. So let me just start our discussion, the theme being, banking for Viksit Bharat. So, Mr. Sethi, let me start from you. So, as you look at banking for Viksit Bharat, there are many aspects that I spoke about in the report. Let me touch upon a couple of points, to all the panel members. So, the question, Mr. Sethi, to you is: we saw that despite a lot of push on digital, what's happening is the costs in the whole industry are rising faster than income, right? And this is not sustainable going forward. So what are your reactions, thoughts on this topic? What can banks do to really reverse this trend?
Thank you, Richin, and thank you to FIBAC for giving this opportunity. I think that was a couple of slides what you have shown were very interesting slides. This particular slide on not getting the productivity gains when compared to the IT spends is something I think most of us are evaluating. The biggest challenge for IT spends is that if you really categorize the IT spends, one is today there's a spend which is required to meet the regulatory requirements. There are something what we call regulatory demands. So they are non-negotiable. Those costs are non-negotiable. Then the secondary category is what are business accretive, that some new business can be done through implementing a process. The third one is essentially to supplement to our user experience, customer experience. So most of the times what happens, a lot of demand gating does not happen. People do not distinguish between what is essential, what is not essential, what is business accretive, what is not. That is one important area to look at whenever we talk about the productivity. The second feature is, I think when we talked about digital transformation and digital spending, a series of technology upgradations cannot be called digital transformation. I think a lot of investment also had happened in the past on the technology upgradation. So the investment in technology, particularly towards digital transformation, has to be that are we creating an end-to-end experience or end-to-end process which will result in the operational efficiency is something what we need to look at. Something which is not related to technology also is important, that we have rolled out an improved processes, digital interfaces, and which has also resulted in ability to handle large set of volume of transactions. Then what have we done with our existing staff? Were we able to redeploy them? What kind of redeployment had happened? Have they been redeployed in areas where they can go out and mobilize business? That also requires, redeployment also requires reskilling. I think a lot of banks have not focused on this redeployment and reskilling part of it. I think when we look at the productivity gains which have to come from the technology spends, we need to look at data, we need to look at technology, we need to look at manpower redeployment, and more importantly, what is business accretive demands is something what we need to look at.
Thank you, Mr. Sethi. And I'll keep moving, quickly touching about different topics, just in the interest of time. So, my next question to you, Mr. Vaidyanathan, the governor spoke about the need for inclusive growth, for India to become Viksit Bharat. What has been, your perspective on how can banks and NBFCs really reach out to vast majority of Indians? Many of them today rely on informal sources of credit. Right? So what is really required, for banks and NBFCs to address that last mile?
So Governor spoke about this, and we all recognize it's a big issue. Issue in the sense that if you think of on the investment side, you find that people on the top of the pyramid get good advice. People bottom of the pyramid don't get any advice. So they make more money, these people don't make money. So rich, poor increases. On the lending side again, people bottom proper pyramid get low interest rate for everything and get credit. People get a high interest rate and get no credit. So this issue of people at lower income segments or lower middle class or unorganized segment not getting either credit or investment advice or good service is a problem, actually, and it is exacerbating the issues in the country in a way, but, in that sense. So this has no amount of policy intervention, calling this priority sector, this, that, etc., has actually helped this issue. Only in the last 8 or 10 years, this is massively getting fixed, not by a remote distance fixed actually, but it is in the direction of getting fixed. Even now, if you see, not just this rural and small business not getting credit, migrants not getting credit, let me say, the gig economy people not getting credit, people of marginalized tribal section not getting credit. It's a common issue. So the biggest hope is actually this evolution of this technology, because technology can make things happen which human beings can't.
Thank you. Thank you, Mr. Rajan. So just moving on, to another topic that I highlighted in our report was on, deposit mobilization. Mr. Chand, if I were, to pick your brains, there is a structural change happening in terms of the way households are saving their money. What can banks do to really counter this trend? And any other, help that banks require to be able to address this issue?
Yeah, it's very pertinent at this point of time. What we see for last 3-4 quarters that mobilizing deposit is a challenge for the banking system. And I think there are two issues here. One, to some aspect, I feel that this is more of a transient in terms of the low growth of deposit happening, typically because of the liquidity scenario prevailing in the market. At the same time, there is bit of preference changing of the savers. They are hunting for higher return. And we have a developed capital market, so their tendency to go to the market is much higher. So when I look at the scenario, both the scenario, as I said, that I feel more of a transient, not a structural issue at this point of time. But at the same time, we as a bank typically need to figure out to address the change of preference happening for the savers. So bank like us, if you look at on the deposit side, deposit is not going to be a generic product, it has to be a bundle product now. So if I expect that a customer would open a PO saving account at this point of time, possibly I need to bundle out to offer many other products along with the savings so as to mobilize more deposit. At the same time, the preference of all these depositories is also not to have more of a branch banking, rather more of a online digital banking. And if you look into these two scenarios, I think the deposit mobilization, which is a constraint at this point of time, would improve. We are seeing traction. I'll just give you a small example. It has been that we need to innovate on the deposit side. Like a bank like us, SIP has been a big, what you can say, a flagship scheme for mutual fund. We had a recurring deposit scheme earlier, but never marketed in a way. So within the recurring deposit, we renamed the product as a systematic deposit plan, SDP. So a SIP gives you an uncertain higher return, but at the same time, SDP gives you a certain modest return. So we need to innovate a lot. Things are happening, but at the same time, my strong view that the current deposit advance growth is more of a transient, not a structural one. With the liquidity improving the system, possibly things would come back and the banks would have a higher deposit growth.
Thank you, Mr. Chand. So just picking up on, the point that you made on innovation, and you talked about SIP. So Mr. Rao, a question to you. The mutual fund Sahi Hai campaign has been, quite successful. AMFI has been in the forefront of doing it. Do you think IBA, being an IBA chair, the banks need to come together to really market deposits a lot more to customers?
Yeah, as far as these mutual funds are concerned and bank deposits, both are on two different ball games. And let us understand why customers are moving to the mutual funds, number one. Number two, how and in what way the mutual funds are offering more returns than the bank deposits to the customers. If we analyze, with the generation shift, cultural change also happens. The earlier culture of security is slowly moving to the culture of securitization. The people who are now keeping the deposits, if you analyze their demographic profile, higher age groups are keeping the deposits with the bank, and all youngsters are moving to the market as investors rather than savers in the banking area. If you analyze further, the returns which are given by the MF, that is mutual funds, is higher because bank deposits cannot give, because our deployment of our resources is regulated so tightly by the regulator, you cannot get higher returns from the deployment. As far as the bank deployments are concerned at every level, we know that end use has to be ascertained. And you have restricted rate of interest for many of the asset products what banks are offering. Vis-a-vis, if you see the mutual funds, I do not know end use verifications, and their deployment, whether it in the priority sector or to the MSME or to the government schemes, there is no restrictions. So that's why mutual funds are able to offer more than the bank deposits. But going forward, we cannot dictate the customers, but the way we have to evolve ourselves and ensure that higher returns be given to the depositors, there the involvement and also active participation of the government and regulators are required, so that these bank deposits, which are really helping the economy to grow, rather than putting the money into the market where at times there may be a lot of risks that are involved. And another thing which you analyze, the investors, so-called investors in the mutual funds, if you say they are investor, I don't think 99% are analyzing the technical or fundamentals. Just they are following, I do not want to call it as a herd, but as a group. So going forward after 6 or 7 years when cycle turns, definitely this will have a lot of systemic risks that may come out. And for example, if a mutual fund invests in a company, even in a AAA, I don't think they have to make any provisions. But for a bank, even for a AAA company, we have to make a provision of 20%. So there are a lot of differences in the deployment. That's why returns are less. That's why we are unable to pass it on to the depositor. But this is the reality. But definitely banking as an industry will come out with some innovations. And at the end of the day, we will see that how we are going to ramp up our deposits.
Thank you. Thank you, Mr. Rao. Zarini, if I way to ask you a question on resource mobilization more broadly, not just deposits, and just being a foreign banker, what are the other avenues, banks can look at to augment their resources, given that credit growth has been faster than deposit growth for the whole industry?
Yeah. So clearly, one can supplement the rupee resources with dollar resources, and external commercial borrowing, FPI flows, dollar bond, etc. could be other avenues of resource mobilization. Having said that, I think the withholding tax incident, which has been revised from 4% to 9% for dollar bond, that has really affected the dollar bond flows. So unless you come via GIFT City, but the issue is that the investors are not based in GIFT City. It's a very widely distributed investments when it comes to a dollar bond. So that is one area, if it can be relooked at, the withholding tax, because the interest rate so far is high, and then there's withholding tax. So the total fully hedged cost is quite high for the borrower. The second area is on FPI. So even FPI, if you were to do it from Mauritius, it might be cheaper than doing through GIFT City. So that also, there is a withholding tax differential, which also hurts money coming from FPI sources. The other area where it can be relooked at is today, if you give a ECB for a refinancing of a rupee capex loan, actually the minimum maturity has to be 7 years, average maturity. And if you do it for non-capex rupee loan refinancing, it is actually 10-year minimum maturity. That you don't get hedging lines. So if it was the refinancing could be made for a shorter period, it actually becomes another way of using foreign currency liquidity to supplement the rupee resources. So, the other thing is, for example, InvITs and REITs, they are not able to borrow in dollars. Even that can be permitted. So there are multiple things that can be done. And of course, the debt mutual fund, I think, post the benefit of indexation being taken away, we've seen about 1,80,000 crores or so has gone off from debt mutual funds. So that is another area which was at least lending to AAA, AA. So that supplemental rupee resources have also sort of diminished. So multiple things can be done to supplement the rupee resources with the banking system.
Thank you, Zareen. So just moving on, Mr. Dave, to another, important area. Banking, is becoming more complex globally and in India, right? And we see interconnectedness between banks and, vendors. So any thoughts on, what can banks do to really improve the overall resiliency in the whole system? Your thoughts from your global perspective.
Yeah, but just before that, if I can just weigh in also on this.
Sure.
I think
Please.
it's an oversimplified argument that because, let's say, people are putting money into mutual funds, that's why there's less money for banks to tap. Because even the mutual fund buys something that is sold by somebody, so that liquidity comes back into the system. So I think it would be good for IBSR to actually do a study, right, as to what typically causes deposit creation. And I think because if we keep blaming SIPs or mutual funds, we might be solving the wrong problem, is my sense. I think the other thing on liquidity to remember is that in 20 and 21, the banking system had enormous pools of liquidity, right? So you naturally went a little slow on the liability side and, tried to deploy the enormous surplus that was injected through RBI and Government of India, etc. I think banking books, having worked in, trading books also, banking books are a little slow to react. And now that the reaction has happened, I think you will see it very differently. The third thing is government balances, right? Last 18 months, government has been sitting on huge liquidity. As now it spends more, you will find the fight for liquidity. But I think it will be interesting to study what is the biggest impediment to deposit creation. Because if Bank of Baroda launches a fantastic deposit scheme, the customer will move money from my bank to his bank. The system liquidity, the system cannot change like that. But on your broader point on long-term resiliency, etc., I think clearly as we become more and more digital, as less and less customers come into our branches, as the personal connect gets a little lost, as the volumes that we are processing, right? Your earlier question on tech spends being at such a high rate is because between 2013, which was the start of your chart, and now the banking system must be doing, 20x, 30x, 40x of what it was doing, right? So I think clearly resiliency in your systems, resilience in your technology platforms would be one. The link thing, I think cyber was brought out there. I think, all of us are exposed to it. I was told my bank globally gets about 100,000 cyber attacks every day. Okay, so just imagine how much money we are pumping into that part. So I think technology resiliency, I think the other thing would be people. My guess is banking as an source of attractive employment is changing. The narrative is changing, and how do we make sure that they feel good about the role that we as an industry play? And third would be regulatory compliance, I think, as the governor alluded to it in his own remarks. So these three I would suggest.
Thank you, Mr. Dave. Maybe I'll do another round of quick questions, and I'll leave some time for audience also to ask questions. Mr. Sethi, coming back to you, SBI kind of has been in forefront of investing in digital. Can you share some, experiences of what's actually gone well, and what could be done even more as an industry to fully embrace digital and get the full benefits of the DPI that India has?
I think SBI, as we keep saying, is a proxy to the economy. Today, we have 50 crore plus unique customers. And the important thing to realize that the journey of SBI in the digital ecosystem is the journey of India's journey of digital ecosystem. I think it cannot be separated. And the way we have adjusted, readjusted, and created the resilience, what Dave was talking about, in terms of the handling volumes which are unimaginable. I'll just give a few data points. Of course, many people know that it's a very large bank, and for instance, we handle 1/3 of the UPI transaction, which means about 18 to 20 crore financial, non-financial transactions a day. This is only on the UPI. If you take on our flagship mobile application, we handle 1.8 crore peak login every day, which means that you not only have to take care of resilience of your backend systems, provide the customer experience, and also see that your cybersecurity stance is strong, and you continue to make the channels available. As you know, we have the largest channel both in the physical and digital, ATMs, business correspondents. Overall, the physical touchpoints alone in SBI is about 1.6 lakhs. So the combination of this magnitude of the transactions, I think the biggest learning for us is that how do you create the resilience in the system? So this is, I personally believe, is one of the major achievements of SBI. And during this process, we faced a lot of challenges. I think biggest challenge every one of us is facing, particularly the banks which have had a legacy system, is that when you want to create an improved customer experience, of course you need to reimagine the customer journeys and also engage with a few fintech players, software solution providers. I think most of them struggle to work with major banks because the legacy systems have to be integrated with the agile systems which they developed. So this is one learning probably the system has picked up from SBI, that many of the fintechs which have worked with SBI could carry the learnings to other banks and were able to implement successfully. The second, in terms of the successes, our retail internet banking is one of the major successes which we have had. Many people may not know our retail internet banking predates our core banking. It's almost more than 30-year-old. The platform is still one of the largest in terms of the registered users. We have about 13 crore registered users on the internet banking alone. And the one which in the last 5 years, which has become synonymous with the SBI, is the YONO platform, the mobile application. We are proud to say that I think after YONO launch, there are so many other banks, particularly in the public and private space, who have come out with mobile banking, and mobile banking has become mainstay of the whole banking experience for the customers. Even on the YONO, we have about 8 crore customers now, and it's growing. But the challenges are, as I said, about how do we work on the legacy systems, how do we hollow the core and move towards more and more microservices so that the agility of the systems and agility of the partners can be made use of. I think that is one challenge. The other challenge is essentially that, when you're moving most of your customers to digital, how do we create the digital literacy and also protect our systems from the cybersecurity incidents? The investment in cybersecurity is significantly going up, but we also feel that the professional support for many of the cybersecurity activities is a limited one. I think that's going to be a big challenge for going forward.
Thank you, Mr. Sethi, for sharing these very valuable experiences. Mr. Vaidyanathan, your bank is known to be one of the banks which is adopting very new age, cutting edge technologies. Now many other banks are trying to adopt these, and sometimes technologies like GenAI may seem to be just a fad coming in and going out. And every 2 or 3 years we have a new technology coming in. What has been your experience of, adopting such new age technologies? Do they really benefit either the customer or, your internal processes? What advice do you have for the whole industry?
Well, the most important thing is to have a technology stack, because if you see Instagram or Facebook, etc., you can flick the screen, it works so well. But behind the scene, there must be stack, something running there, which is the real powerhouse. So, for example, if you think of all the core application systems, typically they're given by the same vendors in the country, whether Finacle or whatever. But then to have a fantastic middleware, to have a really good engineering layer, to connect with the channels where the customer will engage, then that could be the core stack. On top of it, to have a data lake, data engineering teams, machine learning capabilities to pipe from the lake into this, and from there to have capability to reach and build fantastic journeys. Now, these concepts are super important. I call this a stack. You can't see it. It is there behind the screen. If it's contemporary, if it is modern, if it is cutting edge, then the experience layer comes out to be very good. So the short point is that stack is very important to build really beautifully. We put an effort in building that. I think we got a really good stack now. Second thing is, I'd say that eventually when the stack is good, because everything in the customer experience, it's consuming from some data somewhere, and that has to be clean, that has to be hydrated, that has to be. Now that one. Second thing is that if this is there, then the experience layer, we need to build good quality designers, UI UX engineers who can really build good quality screens, etc., app, etc. Once this is good, then you can pipe the same stack into the branch. Your branch experience will be very good. The same stack you can pipe into mobile app, it will be very good. If you give it to a relationship manager, that the screen will be very good. So the building, in other words, building the stack is very important. Then every experience layer, whether anywhere touches it, will become very, very useful. Similarly, the same stack, if it's good, assisted journeys will become very good. So I believe a lot in building a really good tech stack.
Great point, Mr. Vaidyanathan. Moving on to another topic, Mr. Chand, a question to you. Many speakers spoke about the importance of MSME lending in the journey towards Viksit Bharat. There's been a lot of push by the government on MSME lending, but what we find is that not all lending is viable in terms of portfolio quality. Right? What has been your experience and advice, or what can banks do to not just give loans to MSME, but do it in a manner that the portfolio quality is good and ultimately sustainable and profitable for the whole industry?
It's very pertinent in the sense that MSME has been a backbone as far as the economy, and so is the banks lending to MSME in many decades now. So in between there was a challenge with regard to an elevated level of NPA, but now things have stabilized fully. But the aspect which is very important, as we see in the personal loan on the retail side, in MSME also, that is also the government push that the lending has to move from the asset-based to cash flow-based. And more we understand the cash flow of all this MSME, then typically the product offering would be much more better. At the same time, the default rate would be much lower. So many of the banks like us, again, we are looking into the cash flow model, and that is what actually the talk of the budget this time also. And we see that the even asset would be a comfort, but the cash flow really gives you the money back. So I think the time has come to, like we have seen in the personal loan segment, similarly MSME also would be more cash flow based. Bank like us offering dedicated cash flow, cash management system to MSME borrower. And I think on a current level of balance level of the stress book in the MSME, with the growth opportunity, with the cash flow lending, things will be much better going forward.
Can I add a bit of perspective to this in the light of this, the stack comment and the MSME comment? See, what is happening is that if you have a really good stack, now the ability of the stack to connect to, let me say, UIDI, to NSDL PAN for validation, for the bureau, for fraud scorecards, for the many other ecosystems that come in the country, e-KYC, e-mandate, e-agreement, e-collection, the whole capability of the stack to connect will be very good, number one. Number two, the scorecard that we will build in the context of his MSME comment doesn't have to be MSME scorecard. So blunt. What is MSME scorecard? MSME is just a term, millions of. So you can make really high quality. For example, in our case, we don't have something called MSME scorecard. We have a scorecard for salons, one scorecard for chemist, one scorecard for something, because then you can get very, very precise. There are 22 such industries for which we made some scorecards. So then you can have a much more. You have a good stack, your ability to connect, and you have a fantastic scorecard. The whole stack, then we talk of doing inclusive financing. It doesn't happen by just talking about it. So the ability to reach those segments, evaluate them independently, with the capability of technology, gives us the ability to get a good yield also, low credit cost also. Whole combination works. It's profitable, you can reach, and to his point, then you can make MSME make it more real.
Thank you, Mr. Janathan. So, Zareen, just moving on to another topic, there was a discussion also, many speakers spoke about on green finance and ESG more broadly. India still as a country is in kind of nascent stages of ESG development. What has been your learnings, on this topic globally, and what can you advise banks in India on ESG?
Yeah, so globally, I think ESG is really taken off. If we see last 2 years, there's been $2 trillion of raise, financial bonds and loans, etc. So, and year to date, it would be like last few years, cumulatively, it would be about $8.5 trillion. So massive sums of money are going. And in that, about 61% would be green. And the rest would be like social and transition finance, etc. If we look at India actually dollar bond and other loans that we've seen, about $15 billion was done last year, and this year to date it's $16 billion, but it's still 1% of what's done globally. Having said that, I think we're seeing quite a bit of the regulator itself, SEBI and RBI, taking a lot of steps, and we are seeing, for example, SEBI telling the top 1,000 companies to disclose, and we're seeing good amount of traction, especially in transition finance. If we look at what other regulators have done to enable, if we look at Bank of Japan, for example, for one whole year, they give the interest-free, the subsidy for the interest portion of the first year. If you look at Mass HKMA, for example, they subsidize the entire second-party report, etc. So each regulator is doing something to sort of enable. If we look at PRA, the UK regulator, for certain public good, they actually give 25% risk-weighted asset as concessions. So instead of 100%, it will be 75%. So there are various things that we are seeing at play to encourage green finance. Our own bank, we have said that next year we will be in our own operations net zero, and by 2050 even our clients that we lend should be net zero. That's the roadmap. And we have said that we will enable our clients to raise about $300 billion in a decade, and those are things that are well documented. As a bank, we've stopped funding coal-based power plants. Coal particularly has been something that the bank has publicly stated. So there are various things at play, and I think eventually we'll see, in India also some of those global best practices sort of coming.
Thank you. I'm mindful of time and would like to keep some time for open Q&A. Anyone, sir, if you can just take your name and ask the question. If you can have some mics there, please.
Thank you. When we are talking about Viksit Bharat, and in Viksit Bharat, my name is Chandrakant Salunkia, I'm a president of SME Chamber of India. When we are talking about Viksit Bharat, in this marching towards Viksit Bharat, banks are going to play a very important role. Even the Prime Minister, Finance Minister, RBI Governor, even Secretary talk about MSME empowerment. But what is the role or action plan by the banking sector, since the three heads of the Indian bank one leading private bank, 2 foreign banks heads a year. And looking at the this segment, MSME segment, which is providing large employment, now 100 industrial parks are coming. In that, more than 90% industrial will be set up by the MSME sector. So what is the action plan for the Viksit Bharat towards MSME sector? Because front line maybe in next 3 years may be changing, but back line there are a lot of bankers. How they will get a message from you to put more effort. Second question, why not differential rate of interest scheme can be implemented to provide up to 5 crore loan, especially for the micro, because around 6 crore micro and tiny businesses are there. They are more than lower level than weaker section. Why not we look at social angle on the micro or tiny industries to provide a next level support where they can become small, and small will become medium, and medium become mid corporate. Then we can march towards Viksit Bharat. Thank you.
Anyone would like to take the question in MSME?
See, as far as this Viksit Bharat concept to make the country Atmanirbhar in real sense rather than Bank Nirbhar, what we have to think, it is a humongous task. It cannot be delegated simply to the banks. All the stakeholders have to involve themselves. The reach of public sector banks or the private sector banks, and also through the BCs and by other channels, whatever banks are employing, it should be complemented by the NBFCs, which has good reach. At the same time, relevant aspect, what you have pointed out is the differential rate of interest. Yes, that is the good point to be taken. And going forward, definitely this will be the philosophy that will be guiding all the stakeholders who are reaching out to the last mile borrower.
I'll just add to that, so just to add some clarity to that. If you see historically, Mike, if you see historically for hundreds of years, or maybe more than 100 years, the financing for small entrepreneur has been basically working capital financing. So they say, give me property, I'll give you a bank current account, and then whenever you have sales, come bring it here. Every bank has it's called business banking, all banks have. But that is really a very, it's not at all inclusive in any way, because small entrepreneurs, all of them cannot give property. If you have property, then what about 90% of them who don't have property to give? So let me say in the last 8 or 10 years, this changed because of the fact that you can access the PDF form of the bank statement of the customer, and the computer can read the bank statement in seconds, analyze it, find out what is the balance of the customer in the first 10 days of the month, and you can quickly take a decision on that. That is a very big breakthrough. Second very big breakthrough for financing is this account aggregator. Because now, again, it's a digital public good that has come, a public infrastructure that has come. Now, you can actually see the balance of the customer in the multiple accounts, because customer is giving you access. That one, plus ability to see bank statement, plus the ability to do high quality decisioning because of the advanced scorecards available. I'm frankly, first of all, I really feel they have a bad deal in the country, because they really, bottom of the pyramid people, they never got credit for multiple reasons we all know. I won't go there. But I'm frankly more hopeful now than before. If you see almost every lender now, the biggest growing component now is MSME. People think it's retail. Actually, it's MSME. And I think there's a reason, because that market is now beginning to be, the visibility of the customer information is much more today.
Mr. Shetty, you can highlight on the differential rate of interest scheme. Can we convert into up to 5 crore?
Actually, I didn't understand the question very well. You could repeat that. What is the differential interest rate scheme?
Differential rate of scheme is especially for the weaker section.
Okay.
And if you look at the micro and tiny, because India is based on the micro tiny industry.
Yeah, definitely.
Maybe they can talk about it. As far as I'm concerned, this is really again a bit of a tragedy that the person who has the biggest burden, the most stressed, not only here, all over the world, always pays the highest rate. Okay, it's a truth of life. And truth, but it's an unfortunate truth. So the thing is that, but still, end of the day, market economics about where the opportunity takes you is very important. I'll tell you, just because I have personal experience on this for a long time now, let me share the numbers. When I left ICICI Bank in 2010, the first business I started was financing Kirana shops, okay, and all that category. Borrowing at 13%, 12%, lending at 24%. No scheme, nothing was there. That business what that business was at that time 100 crores in 2010. Today, that plus retail put together is 1,60,000 crores in 14 years. No incentive, no promotion, no priority sector, no benefits. Just the opportunity. So I really feel that when the ecosystems opens up, when the opportunity is there, when the drive is there, these things come. That's my thought. You can add to it.
I think in another context I mentioned the credit is an important area for MSMEs. Timely credit is more important. I think this is what we have been focusing for quite some time, that how do we make the credit available to those people who need it in time. And the visibility of cash flows and data and bureau data, GST data, I think a lot of things are helping us to devise rule engines which would help us to make the decisioning much simpler, easier. And today we have done, I think incidentally you are taking 5 crore limit, I don't know why, but in SBI up to 5 crore rupees we have completely made a rule engine based decisioning for credit. There's nobody who actually prepares a proposal and takes a call. It is all purely data based. And we also have built the incentive, because now I know that I'm relying on credible data to take a decision, and the credit decision is based on certain facts and figures. My confidence level is much higher than what used to be earlier. So we are giving that incentive to people who actually qualify to get credit under the business rule engine. To answer your question, the differential rate of interest for those people whom I have the data and I'm able to assess their credit requirement is being given. The biggest challenge for us is that where the data is not available, and obviously much of this lending which happens on the unstructured database is done through the MFIs and NBFCs. And while we are making reasonable credit available to the MFIs and NBFCs, for example, SBI is the largest lender to this ecosystem of NBFCs and MFIs. In a way, you must also give credit to many of the banks, large banks, that on lending to MSMEs through this is also a biggest contribution banks are doing. It is not only our own loan book which you have to look at MSME funding, that the whole ecosystem which is being funded by the large banks, which eventually is reaching the MSMEs. That is also important. But how do we reduce the cost eventually to the MSMEs if it is going through this intermediation process is something what we need to really work on. They have high collection costs. We keep working on them. I think co-lending is one arrangement where the blended costs can be reduced to the MSMEs. There are various ways of doing it. I think as Vaidya has mentioned, MSME is one single sector which is growing the fastest. Even I think double digit, 18 to 20% growth rate is witnessed in MSME. And next analysts probably would start asking what is happening in the MSME space. Is it overeating? The moment the focus now gets shifted from retail to MSME. But I personally believe that the unmet needs of MSMEs are being met now because we have greater ability to assess their requirement in a much more confident way. I think that the lenders are more confident to lend, which is extremely positive sign for MSME sector.
Hello.
Second.
So myself, CA Dheeraj Khandelwal. I'm heading the committee called MSME of the CA Institute. And sir, from last 2 years, we are heading a MSME Yatra in entire ICI
There are a lot
branch,
of people who are not
100 branches.
MSME enough discussion happened. There are a lot of people asking. Just bear with me. MSME हो गया यार, हो गया.
I'm just
Thank you.
giving the facts. Nothing is fine.
Good afternoon.
Don't get me wrong. Let's just discuss MSME.
My name is Vineet Nahata. I represent Powgill Treasuries. I would like to draw your attention towards the green financing. In India, green financing has not taken off as it should have been. The greenium which should be available, it's not present. The sovereign green bonds as well as the bonds, green issuances of corporate bonds. The liquidity is not there, and the exposure of banking industry towards these green issuances is not encouraging. One reason which we find is that there is no tax incentive to the investor in investing in green bonds, the yields which they are compromising on. There is no tax incentive which suffices for that. So I would like to receive your comments and your remarks on this.
Mr. Shetty is best to talk about this.
I think
We are fielding our best batsmen for all the difficult questions.
You have asked the question and you also have given the answers. There's nothing much to add. The so-called greenium is a concept which is not picked up. For example, we have launched a green deposit. Why would anybody put in green deposit? Do you put in green deposit? I say that 50 basis point less you have to take from me because I'm actually funding the green activities. So the disconnect between the savers who do not see any value in putting in green deposits and are willing to take the lesser interest rate is not going to really help us. How do I push a green deposit unless I give less rate of interest and also I'm charging less on the green financing activities? So I think this is something which we need to, it evolves. One thing what is happening is that the ESG part of the corporate lending, I think we may have to adopt some of the European models that you don't give the concession right in the beginning when you give the loan. I think it could appear to MSMEs, corporates, or anyone that the greenium on the loans can be front-ended. While the liability side is still a challenge. When we access the international market and we say that, I'm going to come with a green bond, we did one green bond issuance, I keep asking the investors, you tell me what is the differential delta you are giving me over my regular bond issuance. Nobody is promising me. At the most, they may say that 2 to 3 basis points. The cost of compliance of issuing a green bond is much higher than what I'm going to save on that. So the commitment to raise the green liabilities and commitment to green financing, despite not having any green liabilities, today I think Indian banks are extremely positive in financing the green activities. We have created such a large renewable energy portfolio in the country. I think probably the kind of additions which are happening into the green energy is unprecedented. And we are all helping in achieving, as part of the Viksit Bharat, our goals of net zero, much faster than what is anticipated. So I think without getting really confused on the green bonds and green deposits, let us focus on what is that we can do on the financing side. Ultimately, some of the foreign capital has to come. It is coming. I think I'm told a lot of equity money is chasing the battery storage, pumped storage capacity, and green hydrogen. Obviously, need not be that this has to come from the bank financing. Whichever financing it is coming in and helping us to green the economy, I think we should welcome it.
I must share one important point, Mr. Shetty, actually, that we are financiers of electric vehicles, which is green, basically. We are finding, I'll tell you one good news, which is everybody will agree, that the asset quality of electric two-wheeler financing is actually better than the combustion engine. Delinquency is lesser. Better quality customers are taking it in a profile sense, and that's actually good news for you to the extent that you.
Yeah, so just wanted to supplement. In Singapore and other markets, we're actually seeing sustainable deposits as retail customers putting sustainable deposits, and they are coming maybe 10 basis points cheaper. It's not substantially cheaper, but that has started what we see overseas. And like I mentioned, if some concessions are made on, for banks on risk-weighted assets, those kinds of things, that can again translate into the lending rates. So I'm sure those things will evolve in India also. It's a matter of time.
Maybe just in the interest of time. Okay, somebody's gotten up. So very last question because we're running.
I'm K.K. Gupta from Resurgent India, sir. The recent union budget has announced some concession to the SME sectors, either to have a coverage of 100 crore rupees, bank guarantee. Another important aspect is assessment by the bank themselves, instead of depending upon the digital platform. So just I want to know what the bankers are doing for that, for new assessment models.
Was the question clear?
You were talking about the 100 crore guarantee scheme for the MSMEs, which is announced in the union budget.
Yes.
The detailed guidelines are yet to receive. I think once we receive, we'll work on them.
Another point is new assessment models on the platform of digital platform. You have to introduce without asking any information from the SME sector. So banks should assess their own. This is the union budget announcement.
This is essentially the cash flow based funding, which has been asked.
This is not cash flow. This is digital financing, digital platform. You have to collect the information from the digital platform and assess the requirement of the SME sector instead of asking from the party.
I think we have discussed SME enough. You have a last question, please.
Thanks, Ruchin. Adil Shetty. So the senior bankers in the room have been at the forefront of India's fight back against payments fraud and phishing. August 28th, TRAI had a meeting with all the financial regulators in terms of curbing this problem. So my question is, how can all stakeholders align to reduce this payments fraud phishing problem, but without destabilizing compliant processes that everyone depends on?
I think this is a very big problem for everybody, as customers, as the industry, as regulators. I don't know of any other country where the regulator hires one of the most high-profile actors of all time, like Amitabh Bachchan, to come on TV and say, please don't click here, please don't click there. I think the number of messages all of us must be sending to all our customers. I'm an SBI customer as well, so SBI never asks you for this, SBI never asks you for that kind of a thing. So, but eventually I think technology will, your industry will also have to help the banking industry, because you almost need to know that a call which is coming in is from a bad device or a bad number. And we will have to improve on that, and we'll have to make the cost of fraud on the perpetrators very, very expensive. So every time they have to buy a new phone, not just a new SIM, right? Or to buy a new laptop or things of that nature. But, I think we mentioned digitization in the earlier part of the discussion. One of the unfortunate byproducts of extensive digitization is the fact that there is 1% of the population out there which operates as syndicates. So it's not some one person. It's we've all seen Jamtara, but there are hundreds of Jamtaras out there now. So it is a very good question, and I think the industry, my sense is next 10 years will spend significant amount of money on ensuring that their customers are protected. The risk also is that the regulator or the legal authorities say, listen, up to a certain amount, under certain circumstances, you make good the customer, even if the compromise is at the customer end, which is a law in some parts of the world. So I think it is an imperative, and I'm sure IBA and other big banks will help us find the best way forward.
Just to supplement, actually at the back end, a lot of work happening between multiple stakeholders to see that these are minimized, or any action by the banks on the matter or the stakeholder is in a non-disruptive way. So every day, along with the business, we are talking about how to again control all this. The biggest thing what he said is the awareness level at the user level. That's something which everybody is now trying to drive and bring those awareness. But be certain that the action would be done in a manner which is non-disruptive, so there won't be any disruption there.
Hello. Thank you, everyone. I will bring this, first panel discussion to a close. We had the privilege of, very, very senior members sitting on the dais here. We touched upon a large number of topics, but I think it really sets up the discussion for the next 2 days on various aspects that banks will have to support the whole economy, be it MSME, retail credit, digital technology, ESG, frauds, right? I think there'll be specific, panel discussions on each of these topics separately, but I really thank all the panel members. And thank you everyone for such an engaged discussion. Thank you.
Thank you all dignitaries. Ladies and gentlemen, we will take 5 minutes to reset the dais for the next session. Thank you. I request you all to please take seat as we are starting our session 2. Ladies and gentlemen, we shall now proceed with our second panel discussion on the topic Future of Household Savings, Deposit Mobilization for Banks. I request everyone to take seat as we are starting our session 2. I am pleased to welcome on dais the panelists for this session, Mr. Ashwani Kumar Tiwari, MD SBI, Mr. Prashant Kumar, MD and CEO Yes Bank, Mr. Ratan Kumar Kesh, MD and CEO Bandhan Bank, Mr. Pralay Mondal, MD and CEO CSB, Madam Veena Mahwahid, ED Bank of Baroda, Mr. Nilesh Shah, Group President and MD Kotak Mahindra AMC. And our moderator for this session is Madam Neha Gupta, MD and Partner BCG. I would like to invite on dais Mr. Nilesh Shah, Group President and MD, Kotak Mahindra AMC. I request you all to please take seat as we are starting our session 2. Over to you, ma'am.
May I request the audience to settle down for the second panel? Okay, I think now we'll settle. May I request the audience to please settle down? I know we are running late for lunch, so we will try to wrap this up if we settle down fast. Okay, now hopefully. Okay, shall we start? So, good afternoon everyone. I think the opening panel actually set the context very well for this panel, which is on household savings and deposit mobilization. We all know, it's well acknowledged that this is a challenge. I'll maybe just put out 2-3 statistics which then form the basis for the discussion that I'll do with the panelists today. I think this is the 9th quarter where we saw credit growth outpacing deposit growth. If I look at what it's translating into as the contribution of household deposits and therefore retail flows comes down, the cost of deposit for banks has gone up as an industry to almost 4.8%. In fact, there was a recent analysis which showed that in the June quarter, the mobilization that was done on deposits, almost 67% of that was done at a rate which was higher than 7%. It poses a different set of challenges for banks as they look at the economics. However, I think there is also an element that, not everything is as bad as it sounds. One, overall deposits are growing, but also there are segments where we are seeing growth. So for example, if I look at contribution of rural inflows into the deposits, on an incremental basis, it has almost touched 30% now. It's at 28%, almost a 10 percentage points increase in the last decade. Women depositors as a segment has actually grown similarly. As life expectancy increases, senior citizens come in, there will be more inflows that will come in from certain of these segments. So I think it's a mixed bag. The question really is, where will banks get the deposit from, at what cost, and how do we keep this economy churning from that perspective? With that context, let me open up the panel to start with, and maybe Mr. Tiwari, if I can start with you. SBI has always been at the forefront of some of the innovations that have been done. And many years back, we launched a product called MODS, which now most banks know as sweep account. I think, honestly, beyond that, there are not many innovations that have happened in the deposit side, right? We've seen a lot of innovation on retail lending, both by banks but also NBFC. We've seen on the retail payment side, deposit somehow was a walk-in product and not a get out and get it from the market product. So what's new in the offing in terms of product innovation from SBI?
Thank you, Neha, for this question. As you rightly pointed out, this is lunchtime. Everybody is focused on that first. But so we'll try to wrap it up quickly. And thank you for dispensing with the opening remarks, which we had scheduled earlier. Having said that, I think in the first panel, before this one, the question on deposits got discussed. So clearly, there is a short-term challenge. But my view is that if we think long, then this is a cyclical issue. So it will probably revert back. Secondly, there could be a secular movement towards investment, and which is a good thing because all developed markets go towards that ultimately. So therefore, innovation in terms of deposits is something which has been flagged by everybody, including the governor. And what could be innovations? In my view, there are 3-4 things we have to see here. One is the segment you talked about. So, for example, for us, we are now focusing on 3 broad segments. One is the wealth banking, which was there in many private sector and foreign banks already. But for a bank like us, we had to get our positioning right. So we haven't gone into the real private banking as it is called, which is real high end and therefore requires a very high level of individual attention, etc. But we have gone into something above the normal so-called middle level and the real private banking, somewhere in between. So that's one segment we are focused on. We have created a dedicated vertical for this, a separate platform for this. And it's picking up well, but it's early days. The second thing is in terms of, again, a target segment of trust, societies, associations, and clubs and tasks, as they are called. Again, there we are approaching this segment with a mix of dedicated products, including transaction banking, tying up with fintechs, and also a definite outreach by way of dedicated sales forces. So I think that is the other segment. Third is that we are looking at some of these very low value segment, as they are called, which is, you can call them broadly under the Jan Dhan accounts, etc. But I think there's a lot of deposits there as well, which is just sitting sometimes, and we are not really approaching and getting them. So through the business correspondents, which we have so far used to open the accounts, yes, to also run many of the government schemes, but not so much used as a marketing arm. So that's again another strategy we are pursuing very recently, that can we use them as a proper marketing arm for deposits, though they may be small value, but overall they will add up to a large sum. So I think the larger message is deposit gathering, as you mentioned, is no longer a walk-in. There will be some walk-in for sure. It has to be an outreach to different segments with dedicated products, with special attention. And as I think somebody in the previous panel was mentioning, the more of digitalization, more of distance between the customer and the bank actually leads to less of engagement, and therefore the trust which the customers used to have in terms of placing a deposit and the benefits thereof, I think we have to strengthen that again. So overall, I would think it is still cyclical. It will all come back, but more efforts are needed from us. More efforts in terms of product design, outreach, sales, and attention to detail. All of that has to be done. So it's a slightly different scenario which we find ourselves. We took deposits for granted, no longer.
Thank you. And you spoke about 2 things. Different segments need different approaches, and there are some core product design changes. Let me take the second one first. And, Mr. Kumar, we've discussed this once, that as a system, if we were to do product innovation, it also requires us, as a system, then to have some relaxations in the current norms. There is a restriction in terms of how much can we innovate. So how do you think about that from a innovation spurring perspective?
Neha, as per innovation, we launched a product which was the repo-linked fixed deposit. Yes. Okay? We also got more than 2,000 crores in that product, actually when the repo rate was going up. Okay. But in the current times, when the expectation is that the repo rate may start coming down over a period of time, we are not seeing any traction in that particular deposit. But fundamentally, in terms of innovation around the deposit, I think we need to see in terms of that today you need to offer the same rate of interest for the same amount for the particular bucket, irrespective of the risk of the customer. So I think the innovation would also depend on when the banks would be free to offer differential rate of interest as per the risk profile of the customer. So I think that can also be one of the enablement for coming out with the product innovation. Okay? But I think we also need to see it from a slightly different angle. Okay? We are talking about the deposit rates which are like 11%, which was 13% last year. I think it's important to analyze what are the reasons around this. Okay. I think first thing which is very, very clear that because of some of the initiatives taken by the government, there is a huge efficiency in the entire system.
Yes.
So cash is not lying anywhere, which used to be like there was a leakage of this. Second thing in terms of efficiency in the corporate working capital cycle. Corporate working capital cycle has become half. Most of it has come from the efficient cash management. So it means again the cash which was lying in the system is not available. The third thing that after post-COVID, there has been movement from the financial asset to the non-financial asset and also to the better yielding asset. Okay? And this is happening after the post-COVID. It means this is something which is going to remain like this over a period of time. I think we should not say move away from this ground reality. And why I'm saying this? Because if this is the ground situation, then how we track the banks has to be viewed now differently. And I think we have very proactive and always forward-looking regulator. So I think over a period of time, we need to see when we are talking about a CD ratio, whether the CD ratio over a period of time would be so relevant. Why it should be dependent only on deposit? Why not the deposit and the borrowings? Okay. So I think the way the banks are being tracked also has to change over a period of time. And I believe if this situation continues like this, these parameters are going to evolve.
Very interesting points on structural changes in the economy, structural changes in the balance sheet, and how do we therefore evolve regulation like that. Thank you. Ratan, maybe I'll pick up the second part of what Mr. Tiwari said, which was, or the first part, which was segment-specific approach. And as a relatively new challenger kind of a bank setup, you have two parts of the challenge, right? So how do I attract new customers, but also how do I keep customers without having the wherewithal, the product, the reach that some of the larger banks have? So how are you approaching this NTB, ETB segments in your bank?
Thanks, Neha. Before I go into answering that question, happy Teachers' Day. And here, this whole stellar panel is giving a lot of lessons to me. And I am my ex-boss sitting here. So if I don't answer correctly, I will pass it on to him. So quickly, Neha, a couple of points. I think the whole story about deposits as a subject and doomsday scenario, I think key point is that if you look at April 23 to let's say August 24, that period, incremental credit growth has been 22 lakh crore, incremental deposit growth has been 22 lakh crore. So it's pretty much moving in tandem. That's a very important point. Second, it generally moves in a cycle. And this cycle has been there for, let's say, average around 30 months. And the normal average cycle is 41 months. It's almost nearing an end. I think I saw Nilesh's article today morning. He said that excepting few counters, there is probably going to be more secular bull run for some more time. But even if that has to remain, my sense is it will stabilize a bit more, which means deposit moving to equity will probably get stabilized a little more as you progress. But the point Mr. Prasant Kumar mentioned that the structural shift of household deposits coming down from 56 to 37, equity going from 1.6 to 7, or mutual fund going from 1.3 to 6, that's good for the economy. It's more rebalancing, which is happening in advanced countries, which is happening here in India now, which is pretty good. So rather than complaining about it, you should embrace it. Now, what do we do therefore? Our belief is that you spoke about women, you spoke about SME, you spoke about rural. As a bank, we have an active play in these geographies. 70% of my branches are in rural, and women is a very important segment of our customer base. If you see through the COVID period, 2019 to 2024, the rural deposits continued to hold around 8%, which means that shows the strong resiliency. And as the economy does well, the per capita income goes up from $2,500 to, let's say, next 20 years to $26,000 US. there will be more savings opportunity and it will move in a more non-linear manner, which means the rural and the middle income, which is a bit of an overlap, will have a lot more deposit generation capability. And which is where the banks like us, we can create more micro innovative products to be able to garner the deposits. So that should be our play, is what I would believe.
Got it. Thank you. So some innovative products coming for rural and women segments. Nilesh, no conversation on deposits these days is complete without talking about mutual funds and them taking away all the money. But you know, eventually, like we just say, the money still comes back into the banking system in a different form. But that's not how it's working out, right? So can you help us all understand what's going on and where is the money going?
So, thank you, Vicky, for having me over here. And as mutual fund industry, we transact only in check. Now, if I'm taking money by check, I'm paying money by check, how can money coming in or going out of mutual fund impact bank deposits? I'm unable to understand. Second, as Prashant Bhai mentioned, the government bank balance earlier used to be with banks, now it is remaining with RBI. The sweep account is now with the RBI. In FY23, that number was 1,81,000 crore. In FY24, that number was 1,61,000 crore. Now all of us are aware that there is something called money multiplier. If I round it off these numbers for ease of calculation to 2 lakh crore, and a multiplier instead of 4 to 3, that's about 6 lakh crore liquidity or bank deposits going away because of government's efficiency. In FY24, total bank deposit growth was 24 lakh crore. 6 lakh crore is accountable only by government's one step. Second, what mutual fund collects in 3 years, small saving collects in 1 year. Small savings money goes from bank into RBI's government account, and as and when government spends, it comes out. So maybe small savings is also something which one should consider. The third thing is currency in circulation. RBI's own data of financial savings allocation of households suggests that between FY21 and FY23, total 4 lakh crore came into mutual fund, 2 lakh crore came into direct equity, stocks, bonds, debentures. 9 lakh crore went into currency notes. Who distributes currency notes? Banks. You know which of your customer has currency notes. You need to reach out to them so that deposit can come to you. So between government cash balance, between currency notes and between small savings, we can understand why deposit growth is slowing down. In fact, mutual funds are increasing velocity of money. If money comes to me, I deploy it immediately. I don't behave like small savings. So I am a supporter of bank deposits by improving velocity of money. I am not taking away any money from bank deposits. Now this is all data. Is there a practical example of this? Look at US market. In 401k plan, hundreds of billions of dollars go every year. The total AUM in 401k plan is into trillions of dollars. And US bank deposits continue to remain in trillions of dollars. And we actually need to bring down Indian depositors to American standard. The money market rates in America is 4.5%, 5%. Sandeep Bhai, deposit rates offered by Citibank will be 1.5 or 0.5%. And yet American bankers are not complaining that deposits are not coming to them. Maybe it is time to bring down Indian depositors to American standard, then bank deposits will grow.
कहना चाह रहे म्यूचुअल फंड सही है.
Sir, my limited point is that we are, as Hitendra mentioned in previous panel, there is a need to look at three main components: government's cash balance thanks to their efficiency. And in fact, I proposed very recently to CEA that why not government deploy these balances with banks as short-term deposits? On 2 lakh crore, you will easily offer 6%. That's 12,000 crore income to the government of India. Banks will be happy because they'll have surplus liquidity. There'll be no such wide variation. So government benefits, banks benefits, economy benefits. Such a simple decision.
So mutual funds clearly are the wrong punching bags in the Indian economy. So Binaji, one thing that Nilesh spoke about is that there is different pockets where money is going out, but banks know where the deposits are, where the currency is. Traditionally, like I said in the beginning, that all banks, especially public sector banks, had a lot of walk-ins, and that is fundamentally changing. And we need to have a lot more outbound teams. Structurally, private sector banks always had a lot more outbound teams, and branch network was the strength of public sector. How do you see that operating model changing for PSBs?
See, actually, if you look at public sector banks, right, like you rightly mentioned, with a huge network, it was more of a walk-in business that the banks used to generally concentrate upon. And now with the shift in businesses and the deposits facing a lot of crunch, public sector banks have also started moving out to get more of deposits. We have kind of got into more of relationship banking. And the main problem for us happens to be, in the current scenario, the cost of funds, because of which we are forced to actually move out. If you kind of look at whatever the previous speaker has just said, the money is within the banks, but it's again the cost of funds which really matters for us. So what we have traditionally done is we are getting into more and more of relationship banking, moving out, trying to garner more deposits, and probably getting into markets which were earlier uncharted. Probably, if you see most of the public sector banks, at least for Bank of Baroda, we have a huge rural and semi-urban network, which was traditionally a walk-in kind of area for us. But now we are going more and more out into those pockets so that we are able to kind of get businesses, and also trying to compete with the other people, because the funds which are available in the market, especially the low-cost funds, everybody is after those funds. And for us, we have realized that if we do not move out, it will be difficult. So we have also started getting into kind of more and more product innovations which are there, and also move into the markets and give specialized services, in the sense through our relationship managers, and also go in for funds which are available everywhere, trying to get in a huge amount of funds which are available in uncharted markets, probably the blue oceans, if you may call that. And this is what we have been trying to do by getting in the funds.
Got it. So, Pralay, maybe tougher or the toughest question for you in the end. But cost of deposit is going up. There is more public sector outreach happening. OPEX is going up. As a bank which is more specific, small, how do you then make the economics work going forward?
Neha, this is a complex subject we're discussing, and in spite of everybody speaking, there is no solution to this, okay? So let me just try and address the bigger issue, and then I'll specifically talk about you. What Nilesh said is very right, but the fallacy of the whole thing is that firstly, the household savings has gone down by almost 10% in the last decade or so, last 11 years. And it's not necessarily bad, because that is going into other consumption or going into other kind of non-banking financial instruments. Can be insurance, can be, that's good, because health insurance and other insurance still very low penetration in India. It's going to mutual funds, it's going into stock markets, capital markets, and that's very good actually in a way. But that doesn't take the problem away from the banks, because what Nilesh said is very right, that in some form the money comes back to the bank because it's circulating there. But the predictability of that, and we also have to, in banking system, we have to handle 4 or 5 ratios. A CD ratio, the NSFR, the LCR, CASA ratio, and all of that stuff. Now, this circulation doesn't help in some of this. For example, if you still go back and get funds through borrowings, that doesn't help you in your CD ratio, and somebody will come and say, your CD ratio is 94%, private sector bank CD ratio has gone up to 94%, but that's a structural issue, right? Second thing is LCR. If you look at the overall SLR, CRR, and LCR component, and there are conversations happening on further, challenges on the LCR in terms of what's happening. And if you add that up, roughly, it will go to 32.5%. And hence, you will never have a situation where an incremental CD ratio can be less than 100%, especially for certain banks. Okay. Now, these are structural issues which now we have to all sit together and solve the problem. Having said that, I think the fundamental issue is that consumers, okay, currency in circulation. Currency in circulation in the last 7-8 years have significantly gone up, right? We know that data. Now, among various other things, what's also happening is that when the customers are going from a financial savings was very high during the COVID, okay? And now the consumption has started happening or other disintermediation is happening. So what is happening is this money is moving, and then there's a kind of a leakage that happens because the money doesn't straight come to the bank. It comes via media, and somewhere the currency circulation increases in the process, in the intermediary. Sometimes it's permanent, sometimes it is with a lag, it comes back. The problem with banks is we have to manage ALM. When you have to manage ALM, it doesn't help if Nilesh talked about government spendings. The money comes back. First of all, that issue is there. The 10% is now directly between RBI and government. But for me, I have to have a predictable ALM from a treasury perspective, and I cannot depend on when government is going to spend and when liquidity is going up. That's why you'll see in the system that at the same time when liquidity is high at this point of time, 2.3 lakh crore or something like that, bond yields has gone down, which is automatic. Or even more, call money rates have gone down. Okay, call money rates fluctuate, but banks cannot work on call money rates, right? They have to have, and hence we'll see that deposit rates are going up at the same time when your call money rates are going down. Now that's the dichotomy we have to understand, and we have to solve that problem. And we'll come to that question. I'm sure you will have some time, to decide what are the solutions. So coming back to, so this is the larger issue, and hence we have to solve this problem at some point of time. Otherwise, this combination of LCR, CD ratio, other thing, CASA. Okay, why is CASA? CASA ratio has come down by 4% in the last 3-4 years. What is the reason? Not a bad reason at all, because the same thing which Prashantji has talked about, that efficiency in the system, like with UPI coming in, okay, with CMS solutions. I remember many years back, 13 years back, there used to be, CMS solutions which even banks like HDFC used to give. We used to make a lot of money in that process. But now everything is instant. Now we are talking about 2-hour, 3-hour clearing, okay? So which means that the float income, the float business which banks used to enjoy, that is gradually going down, both in savings and current. Is it bad news? Answer is no, it's good news for the country, but banks have to figure out how to handle this, and hence the efficiency of this combined with the higher interest rate is bringing down CASA ratio. So these are the challenges which we are facing today. Coming back to specific questions on our bank, we are very small, so not that relevant in the whole ecosystem, but still let me answer that. Is we have a very high gold loan portfolio, and we also have fair bit of deep geography distribution. To that extent, our interest rates on the yield side is slightly non-elastic vis-a-vis the interest, because you cannot change that interest too much up and down. But for corporate businesses, that yield keeps going up and down a little bit based on the overall interest rate scenario. The other thing which has recently happened is, from a regulatory perspective, the penal interest, you cannot charge anymore. Okay, that happened from last quarter. And that also has an impact on the NIM. So overall, we'll see a slight bit of impact on the NIM, which is happening on the ecosystem. And with interest rate still, I think, combined interest rate, because a lot of old, low interest deposits are getting repriced still in the system. And hence, we'll see another quarter, maybe 2 quarters, the cost of funds will continue to go up, maybe taper down a little bit, and hence there will be a NIM compression across. So we have a high NIM bank, but we also had a challenge in the last quarter, primarily because of this penal interest as well as the interest rates going up. But as interest rate falls, let's say people are talking about Fed, it's obvious, I mean, it is going to happen in September, and as and when RBI thinks right, maybe next year, next calendar year. So if it happens, then as interest rates starts falling, you will see that overall this NIM stabilization will start happening to some extent. So we are comfortable on that at this point of time, but truth is that incremental cost of deposits is continuing to go up, and I don't see an easy solution to this.
Yes.
Last point I want to make quickly, just on quick point, is which is good news again, some amount of intermediation which used to all happen through banks is starting to happen through non-banks. For example, there are so many IPOs that are happening in the system, so much of money which is going to the mutual funds or to the capital market, going as bonds to the corporates, etc. Some amount of intermediation which is happening, which is outside the bank, and hence some of those corporates, they are also stronger balance sheet, and to that extent the retail growth has happened much faster than the corporate growth right now. Now, as the capex starts coming back and this infrastructure and other investment starts going up, I think those productive investments will lead to higher corporate credit eventually at some stage, and hence the challenge will become bigger that while retail is coming down in terms of percentage, once that starts picking up, banks have to be, because still the debt markets and everything is not that mature, that has to start happening. So we need to find a solution to this, and I'm sure we will have that discussion, what is the solution. Thank you.
Thank you. So like you said, no easy solutions. I'm also just conscious of time, and I know there's a lunch waiting. So maybe I'll open it up to the audience. We can have 2-3 questions before we break for lunch. And if not, then I have another question. Yes, the gentleman there. Can we please pass the mic? Wo is quite inside, so they're still reaching with the mic.
Hi, I'm Parag Srivastava, heading the Financial Institution Government Banking for Ujjivan. Just to take the point what Mr. Prashant sir has raised, so there is a bit of banks can differentiate on asset pricing, but that freedom or flexibility currently as per regulation doesn't exist for the deposit. So obviously one is rating what you mentioned, but also like today being a Teacher's Day, if we want to give some special interest for that particular profession or segment, that flexibility is not there. So do you think that some of those rules and regulations also need a review, because the freedom to banks should be a bit more to price or innovate?
I think that's what you alluded to. Yes.
No, I think I'm not able to understand whether this is a question or you are saying this is a suggestion where regulators have to work on.
Yeah, my question was, is it time now to kind of review certain regulations on terms of deposits? Because currently, if we only differentiate, there are 2 categories, retail and bulk, which is defined by the amount. Otherwise, within retail, the only senior citizen is a category where you give a premium. But if you want a profession-wise or maybe some other parameter-wise to work out a particular scheme, that freedom is not there.
No. So what I was talking about, that suppose if I take a deposit of 1 crore from a retail customer, okay, then say for 6 months, then for 1 crore deposit for 6-month period, irrespective of the customer, I have to pay the same rate of interest. The question is, if a deposit is coming, say, from a financial institution for the similar period, okay, where for LCR outflow is 100% as compared to LCR outflow of 10% from a retail depositor, why I should not be in a position to offer a better rate to a retail depositor? I would be able to do that if I am having a freedom not to offer the same rate of interest to a corporate or the financial institution.
Anyone? Yeah, final question.
This is Harish Prabhu here. I'm an ex-banker. As I see it, that the banking sector, would have a serious challenge on the liability side. I mean, given that there's a generational shift, right? I mean, there used to be a time where, I think India is now obviously a very young country. And with availability of information to the Gen Z and everybody, the financial literacy is improving in a big way. So hence, if I meet a lot of people who know they don't care about bank deposits, right? I mean, they are now, because your bank is in the pocket, your broking account is in your pocket, their proclivity is to actually, invest in the markets, right? So from the point of view of, what my question is to both, Mr. Shah as well as, Mr. Prashant or anybody, how would the banking sector really, solve this, fundamental structural shift from, let's say, a earlier gentleman, maybe my generation or earlier, okay, only bank deposits, right? Now you've got multiple options. So, and the differential in returns, right, potentially, given the economic, Viksit, Bharat, blah, 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 over the next 10 years, there's a huge differential. I hope my question is, what do you call, logical.
So again, these are issues where five blind men are trying to identify elephant. There is no one right or wrong answer. But the challenge for India is its plumbing. If you look at credit to GDP ratio of China, Japan, US, they are significantly higher than India. Where are we lacking? The velocity of money in India is much lower compared to others. Now, under Basel, if you take money from endowment trust, financial sector companies, by and large, you have to provide higher liquidity ratio on the same. And that's essentially coming because their endowment trusts are like hedge funds, trading everything under the sun. But the same definition is applied in India, where my trust is like Tirupati Devsthanam Trust. They put bank FD and forget about it forever. But the same charges are applicable in India for money received from trust as globally, because we followed Basel norm. Effectively, between liquidity coverage ratio and the loading of CRR, SLR, 18% of India's bank deposits is not eligible for recirculation. Now, can we deviate from Basel norms and make it suitable to our trust requirement? This is where we need to change the plumbing.
I think maybe the last question and then we'll close. Yes, ma'am.
Sure, thank you. So I'm Kanika, Chief Economic Advisor, Union.
You'll have to be a little louder, please.
Sure. Hi, I'm Kanika Pasricha, Chief Economic Advisor, Union Bank of India. Just referring to some beautiful points made by Mr. Nilesh Shah on how the government efficiency is also restricting loanable funds for banks, because this just-in-time is just taking away the government CASA from a banking sector perspective. While government is on the one side, on the other side, you just mentioned about RBI, because money creation process is in RBI's hands, and in a withdrawal of accommodation mode, we keep talking too much about deposits, but the money creation itself is slow because the RBI would want that CD ratio that Prashant sir mentioned to be lower than what it is today, maybe not as high as 94% for some of the private sector banks as well. So is it that we are, while the government needs to be commended, but on the other hand, the RBI also needs to be commended to try to achieve the objective to lower CD ratios and credit creation process coming down. So your thoughts on that? Thank you.
So it's a very, very good question. But please remember that RBI, unlike any other central banker in the world, is not targeting just inflation or employment and inflation. In India, RBI targets multiple things. They have to worry about inflation now under statute. They worry about rupee. They worry about banking sector stability. They act as a merchant banker to Government of India. They also worry about GDP growth. Now, all these are conflicting objectives. You want to maintain banking stability by keeping CD ratio in healthy balance. You want to increase liquidity for the same. Inflation will go out of control. you want to tighten rates, the cost of government's borrowing program will go up. So RBI is like a magician which is rotating balls at all point of time. And the ball which requires maximum attention, probably they'll put little bit more effort over there. So your observation is valid, but do remember the limitation within which RBI is trying to operate. Do remember the multiple objectives which RBI is trying to balance. And hence, I think it is up to their better judgment what kind of money supply is appropriate for managing all these multiple objectives. But if we can improve the plumbing of Indian financial system through government balances, through currency in circulation, through reclassification of trust deposits, RBI's job will become much more easier. Let me give you one final example of how difficult RBI's job is. As a country, we'll have how much savings frozen in gold and silver and precious metal. The number could be in trillions of dollars. This is the money leaving India's banking system because we don't produce 1 gram of gold. So there are multiple challenges in our plumbing system, and hence if we can make life easier for RBI, their productivity, their efficiency and their output will improve multiple times from current level.
Yeah, just one quick comment to what Nilesh said. Well, I completely agree with Nilesh, but if you look at the reserve money over the last, let's say till mid of FY22, has been growing at almost 15% year on year. But last 2 years, it has come down to 7 to 8%. And of right reasons, of course, inflation control and all those important reasons that RBI has been focusing on. Now that inflation is under control, and now that the growth projections are pretty healthy, probably there is a window left with RBI to increase the reserve money, sort of taking it up to the slightly higher growth trajectory.
On that note, lots for RBI to think about, lots for banks and other financial players to think about. And like Nilesh said, fix the plumbing, help solve the problem. So thank you, everyone. Thank you for the panelists for the discussion as well.
Thank you, all dignitaries. Ladies and gentlemen, it's time to break for lunch. Please be back by 3:15 so that we can start our next session on time. May I have your kind attention for the lunch venues? Managing committee members and the speakers, please join us for the lunch at the Sunset Lounge on the pool and spa floor. And for other delegates, lunch has been arranged at the food staging area next to this hall and also arranged at the Lotus Room on the lower lobby floor. My colleagues will guide you to the lunchroom. Thank you. Welcome back, ladies and gentlemen. We are starting our session 3, and I request all to please take seat and keep your cell phones on silent mode, please. We are just waiting for the other panelists. Yes, sir. नहीं, अच्छा। I request everyone to take seat. We are starting our session 3. Ladies and gentlemen, we shall now proceed with our third panel discussion on the topic, the decade of MSME, will it become a reality? I am pleased to invite on dais the panel of speakers, Mr. P.R. Rajagopal, ED Bank of India, Mr. Rajan Paintal, ED Yes Bank, Mr. Rakesh Singh, CEO Aditya Birla Finance, Mr. Ajay Kanwal, MD and CEO Jana Small Finance Bank, Mr. Sabyasachi Goswami, CEO Perfios, Mr. Bhavesh Jain, Chief Revenue Officer TransUnion Sibil. And our moderator for this session is Mr. Mayank Jha, MD and Partner BCG. I request all panelists and the mod to please come on the stage. Request Mr. Mayank to initiate the discussion. Over to you, sir.
Check. Very good afternoon, everyone. So this is the first session after lunch. Let's keep the energy levels a little bit up. After a good lunch. We have a very esteemed panel today on a very pertinent topic. The way we have seen the advent of retail finance in the country over the last decade is something that we can expect with the MSME sector in India going forward. We do believe that the last decade was ruled by retail as a business, and the coming decade will be a very important agenda from an MSME perspective. Let me lay down some of the aspects because of which we do believe in the MSME opportunity. I think as we look at the country, we have a huge MSME population. You know, this will be larger than many countries put together. But if you look at formal finance penetration in these MSME segments, out of a total of 64 million MSMEs, only about 25 million have any sort of formal credit lines. And if you look at active credit lines, they're even lesser. As we look at the opportunity side, this is a very important agenda from an employment perspective, from a GDP contribution perspective. We are expecting MSMEs to be contributing over 40% of GDP in the coming years in the journey to Viksit Bharat. But MSMEs will need to grow, and they will need the right amount of capital to be able to grow. If we look at the unmet demand today, we are staring at a staggering 60% of MSME demand for credit, even unmet today. So this is a sector which is waiting for formalization, and a lot of panelists today have actually taken the journey of formalizing, bringing the top of the pyramid that we see here into formal credit penetration. As BCG, we had done a survey of MSMEs a while ago. And what we had seen was a staring set of opportunities at us. While we spoke about the access to credit, what we also saw was many of the MSMEs who hold a current account with a bank do not hold any other product with the bank. Only less than 50% MSMEs we saw holding more than a current account product with the bank. So this really indicates how banks can go out and take this opportunity to be able to cross-sell more to their MSME customers. When we saw their digital behavior, I think COVID did a lot of change to digital behavior of MSMEs. And most of the MSMEs that we surveyed ended up saying digital sales in their business will keep on increasing. So that is the confidence that MSMEs have on their business in terms of digital. And as they look at what propositions are offered by banks and other FIs, most of the people that we surveyed, more than 50%, were willing to pay FIs for a value-added services they could give along in addition to an account or in addition to a loan. Right? A contrast was how they perceived taking a loan online. And this is a contrast that we had seen. They still preferred that they are assisted in the journey of taking a loan. And hence it means there'll be accelerated investments that will be needed on the digital side, but it will also mean the form of those engagements with customers are going to look different than the retail customers. While the penetration is increasing on the MSME credit, which is explained on the left-hand side of this page, but the credit quality continues to be something that we have to be aware of, especially on the NTC side. This is an important area that needs to be addressed. We see that NTC bad rates are hovering around 5.5+%. And some of the panelists will know these numbers more recently and more closely. But it calls for how do you leverage data for being able to underwrite these customers better and have better fraud prevention mechanisms. Leverage data, leverage the power of AI and ML to be able to detect frauds when we are giving loans to MSMEs. it also underscores the importance of better collections practices in the segment. So while there is a lot of opportunity staring at us, this is a business which requires a lot of thinking as you plan to scale the business up. But what we are seeing is when it comes to underwriting these customers, there is now a multitude of data that is getting available. Earlier, the way of underwriting MSMEs used to be, I would go to their business locations, try to assess through subjective discussions on what the business is going to look like. But more and more, the business is moving towards cash flow based underwriting, but not just cash flow based. Now there is a lot of alternate data. Bureaus are maturing. The commercial bureau is maturing in the country. The entity data that is available through digital API integrations with government services, utility services, is available to us. There is social and mobile data which is also being available. Now, all of these are increasing indicators, and the real value is how do you read this data and what sense do you make out of this data? And MSME lenders who are able to crack this part of underwriting well are the ones who are going to succeed here. So, to this panel, I think as we think about building the decade of MSME, we are looking at 5 key questions. How do we bring more MSMEs from informal to formal segment? How can industry leverage the data which is traditional and alternate to strengthen the underwriting? How can digital adoption increase? How can operating efficiencies get better so that you can keep reducing the yields that are charged to MSME players? And last but a very pertinent one, how do we avoid the over-leveraging of MSME customers? They are not burdened beyond a point that the credit culture on MSME starts getting disrupted. This is the agenda. Let me start this discussion and open with you, Mr. Rajgopal. We have seen, PSBs have been at the forefront of getting micro enterprises into the formal fold. Your reach is very, very deep in the country. How do you look at the MSME opportunity, and how are you perceiving the growth of MSME as a segment in the country?
See, good afternoon to all of you. I am very positive on this for a very simple reason. The data that you have already presented, it shows clearly that there is a huge opportunity for us. And especially we have been doing very well in micro. So I see a lot of opportunity in terms of actually growing there. And I see a lot of transition from micro to small enterprises. So see, if you look at even the standard accounts that we have, which are not DPD, these accounts have a lot of opportunity in terms of giving more credit and giving second dose, third dose, that kind of credit. So we see a lot of opportunity there, and we have been expanding very well over a period of time. In the last 3 years, I have already grown my book almost by 30% plus. Okay, so and added to that, if you look at last year and this year, year-on-year growth, is almost 20% in SME. And my view is that this 20% will continue to be there going forward. You look at these different segments where MSME has been catered to, whether it is scheduled commercial banks or NBFCs or cooperative banks, there is a huge year-on-year growth that we have seen in the last year. So there is a huge opportunity, and then we are very gung-ho about it. We are also doing everything that is required to be done, that you have talked about digitization and formalization, all those things are getting done. Okay, so that is one great advantage. One data point that you have said, which I would like to actually add, is that 5.8% is delinquency ratio in new to credit customers. You look at the proportion of new to credit customers in MSME universe, it is almost 41% and continues to be 40% plus in the last 3 years. So naturally you will see delinquencies. So what I see in MSME is a lot of formalization has started happening. People are coming and borrowing, they understand. So there is a lot of education that has happened through fintechs. And like you said, a lot of ERP systems are getting managed by them. Accounting systems, receivables are easily accessible to them through apps. So there is a lot of opportunity for us to look at. Accounting is better now. So we see a lot of opportunity there. Thank you.
Rajan, maybe if I can pick your brains next. How do you see MSME as a segment? What has happened post-COVID? How are their own individual businesses looking like? Is this the right time to keep driving growth on the MSME side? What excites you and what makes you cautious?
So you asked many questions in one question actually, but let's go one by one. Should a bank or an NBFC be excited about the business? Obviously, yes. It throws a huge opportunity. The segment is doing very well. Post-pandemic, obviously, a couple of things have happened, but it's important to first dissect the business to understand it fully. When you talk of MSME business, first of all, if you keep the term loan aside, which typically is in the domain of the NBFCs, but if you look at the overall working capital management, then this includes a proper understanding of the trader or the manufacturer or the services sector, so whichever sector you are rendering to. And while at the underwriting stage, this business still hovers at around approval rate of 60%, 50 to 60%. So when people talk about penetration, the first question which comes into my mind is that, is it reaching the last mile or is it first servicing whatever is coming in your hand? Because that is equally important. The third part is through the relationship management, is this customer only looking at the lending opportunity or is he looking at beyond, right? Is he looking at you as a partner who can provide him the solution for his business? He's not looking at only one lending product and there are 10 banks or 15 NBFCs to kind of give him the lending option, but he's definitely looking at much beyond. So this is, just to kind of summarize. From a perspective of post-pandemic, I think pandemic has taught that even MSMEs have to look deeper into their organizations, what they're running, and the organizations have to be extremely efficient in running. So efficiency, digitization, GST of course was in the running, but it got momentum post that. So a couple of things have happened post-pandemic which has made them more organized from that perspective. Reacting to the second part, that what are the risks? Obviously, irrational exuberance in any kind of lending is always counterproductive. So sooner or later, you have to pay the price for that. While the market is large, you need to have prudent underwriting systems, and which can include fetching the information today, fortunately, which is available. Apart from that, your underwriting processes, the touch and feel is important. But I think the risk in MSME lending, like corporate lending, goes even beyond the lending part when you are approving, right? Because at the time of approving, if he is very good, that doesn't mean that he is going to continue to be good. And hence, if it is a cash flow lending, which it is, I think post-lending also, you have to be cognizant of the cash flows, and which actually goes through a process of more products to the customer. He needs a current account, he needs a collection account or a current account, he needs CMS, he needs better cash management, he needs trade products, he needs Forex if he is into the EXIM line of business. So he needs various products, and of course, you have a tight eye on how his transactions are going in. So what used to be a physical inventory process, today you can possibly have your systems tagging on to have a close check on the velocity of funds, also on the GST and other information, which gets you insight from time to time. And at any given point of time, you would always have some clientele which you will have to exit. And there is certain clientele which you can take up in your exposure. So unlike the retail funding where your decision is once the term loan is given, then the story is over and then you do not have much control. I think this is a process. If you have prudent practices, you will not actually suffer in this segment. And we have seen over the years how the delinquencies remain under control. But one line which I always keep on repeating, that when you're going for MSME lending, collateral should be the last thing you should look at. Look at the cash flows, look at the headroom available for his doing the business, and look at what kind of prudence he is maintaining in controlling that business. And post that, at the back end, you should have a tight control on his entire business going on.
I think this last point around, cash flows, not collateral, I think this resonates a lot, in our work as well. I mean, as you think about underwriting, it is really the ability of the business to be able to generate, works best in terms of management of delinquencies. Maybe shifting gears to Ajay. Ajay, your bank has worked a lot on the micro segment side. How do you keep that engine going in getting more micro SMEs into the formal fold? And what is it that you really look for?
Thanks, Mayank. So, I mean, our experience with the micro enterprises really is, they lack formalization. And so you need to build a risk model which kind of accepts that. And you're able to then lend on a basis of less formal numbers, right? So let's say you have a bank statement which is light. You really want to then figure out what is the other mechanism to figure out what his turnovers are. And that means a bit more harder work. So the informal segment remains unaddressed because it's a lot of hard work. But as long as you're able to put that kind of hard work, then you can address that segment. On our side, we've also figured out that it is better that we are analytically driven. So we have built a customized scorecard to address the micro segment because you really get very clear patterns of how they behave. Secondly, we go to once we bring them in, and we may not bring them to the full potential they need, we then educate them on how to formalize themselves because ultimately their growth is in formalization, whether it's with us or with the larger ecosystem. So that's the second piece. I think thirdly, you spoke of digital, so there again, the more they're digitized, the more they're formalized. So then, getting their QR codes to their businesses, like Rajan mentioned, the current account in the banks, getting them to really understand a bit more around taxation, helping them with other accounting answers, really getting them to the fold of, I will only grow if I formalize. We do that on a continuous basis. But like I said, it's a little bit of hard work because at the start point, they don't have the data that typically a bank would use. We spoke of cash and collateral a minute ago. See, when you're not sure of exactly what income it is, collateral always helps. That keeps him honest. And at some point, then you can start diluting that.
So, Ajay, maybe given that micro is the real formalization opportunity, let me ask a follow-up question. You mentioned that the informal segment actually has limited data availability to be able to get confidence on starting to lend to them. And you said that we have to go and do a bit of hard work. Does that mean that hard work is going to be human intensive? Do you see tech breaking this sort of compromise in your business? Or is it to say that, if you have to formalize the informal, it is going to be very, very manual and very, very hard work? What are you seeing in the business?
Our experience till now, it's a hybrid model, which is I just can't depend only on the person, which is why we have customized scorecards. We have as many APIs as possible to check all kinds of data. If he signs up for it, whether it's his own GST returns or if he has his bank accounts, his tax returns. We would also, but let's say I don't have enough data. right? I will use my scorecard because I've obviously got psychographics, I've got bureau behaviors. I figure out getting is good. I'll have to talk to his vendors. I'll talk to his suppliers, right? So a lot of data we can pull, but you will need a hybrid model. As you formalize, then you go more towards AI ML. As you go towards informal, you need a hybrid model. I would argue that only a human model is quite risky. That would make it very difficult because you're treating with the informal segment. If you don't have gating criteria, you run high risk of subjectivity. And if you're operating in 200 cities, fully manually, then you know what to expect. So I do think hybrid is the answer, and as you move up, you would reach less human intervention, but more AI ML answers.
Got it. Sabya, maybe if, on a related topic, how do we, given that we are talking about formalizing, how do we get, tech and specialist solutions like you guys put together? How does that help in A, understanding customers better, and B, reducing OpEx?
Okay. So I think while everybody feels technology implementation is the key, I would rather reverse it and say understanding the problem is the key. Implementation is the easiest part. So let's understand what is the problem for the micro SMEs specifically, because when we talk of SMEs, we are typically talking of the large SMEs, which everybody is trying to capture. The problem is really on the ground, which is micro, which is large part. And even in the SMEs, when we say, your data showed that 40% is into formal sector. Out of 40, also if you go a little deeper, it is meager 14 million out of that only has access to formal. So actually it is not even 40. So that's a problem. Now, and micro consists of the large part. Now, while we talk of micro, what are the top 4 or 5 challenges? First is the access. That means, as Rajan just pointed out, cash flows instead of collateral, but that's not the truth. On the ground, everybody looks for collateral first. So obviously they don't have access. The second is we are a little averse to NTC, we all know it. So we look for a little bit of past data. Again, that goes against micro, right? The next is the kind of complex application form filling itself. It's not easy for them. While we feel as bankers in the room, it's part and parcel, for them it is not. Third being the regional disparities. So there are pockets where the SMEs are catered well, and there are a large part of our country where we don't want to go there for whatever reasons. I don't want to get there. And even SMEs do not have the voice to attract the banks there, or formal financing for that matter. The third being the cultural challenges. So if you look at all of this, technology has different ways to solve. Let's say the first one. Obviously, we all spoke alternate data. There are about now 14 or 17 alternate data that you can use for SMEs. You have already showed that. Udyam registration is going by the year. So are we using it fully, leveraging it fully? No. We have created some programs around it, but not fully leveraging. Apart from Udyam, GST registration is going up. There are obviously policymakers trying to bring many more SMEs into the fold. It may still take time for micro SMEs to get there, but that data point is available. The myth that they don't understand digital, it's a myth. They understand digital. There is complete awareness. From 7% in 2007 to about 70% plus adoption is rural. So I think very clearly they understand. Now, if you look at all of this, I think the next big part which the technology can solve is they understand technology and there is data available in abundance. But what we mistake is that we try to bucket all SMEs in under pretty much 4 or 5 criteria. I still remember my banking days when we used to use industry margins. It still exists pretty much. But you can't fund micro SMEs at industry margin concept, right? Even though you look at cash flow, you have to look at it very differently, right? When we look at alternate data, do we factor in seasonality? I don't think we factor in very much. I mean, there are progressive banks or financiers who does. I will not paint everybody with the same brush, but long way to go. So from a technology perspective, I think all this data is available, like complexity of form filling. We have created a solution where only 2 inputs can fill all your forms and pretty much get to the next stage of analyzing the data. So why do you have to ask the customer or your branch guys or your field force to ask 20 questions? Don't need to, pretty much. So I think the technology is already there. It's just about changing that mindset, making those policies available to facilitate the micro SME specifically to come into this fold. Of course, I can go on and on. There are so many data points that I can talk about, but I think for now, I mean, given the time constraints, I'll limit here.
Thank you, Sabya. And to a related point that you mentioned, there is an abundance of alternate data which is coming. Maybe Rakesh, if I can ask you, how are you seeing the leverage coming from alternate data and being able to drive better underwriting for the business? You do a lot of MSME business. How are you seeing the alternate data playing out? There is certainly a different level of maturity from different sources. GST is a couple of years old now, but new sources are also emerging. There are new fintechs who are also tying a set of data to create their own scores. How are you seeing alternate data or signals beyond bureau working for you?
So, Mayank, in your opening presentation, you showed we have some 64 million MSMEs. 99% of them are micro in nature. Their needs are very micro. Their loan requirements are very, very small ticket size. And also you covered that whatever happened on the consumer side in the last decade or so, can we replicate it on the MSME side? That's exactly how it will play. Because when the needs are small, the cost of delivery to these small businesses has to be digital. And I agree with Ajay that it has to be hybrid, and we call it phygital, and that there can be different ways of doing that. But one needs to build different scorecards, different risk assessment models for small ticket loans. And if you look at, it's just not about you're giving a loan, but embedded finance, discounting the invoices. So it has to link to the larger ecosystem. The small micro businesses has to link to the larger ecosystem. So they are supplying to an anchor. So those things has to be, or they are buying from there. All of that has to really play out. So the way I see it, alternate data apart from GST and the digital, almost 45-50% of the micro SMEs are now using digital payments as a mode. That really brings in a lot of information. Sabya mentioned about technology, use of banking statements, analyzing the banking behavior of the customers, some bit of commercial bureau, and that has to further strengthen. And when you are talking about small businesses, differentiating between an individual bureau and a commercial bureau is very, very thin line, because a lot of them are proprietors, and that's how they have built the business. So if we have to go the last mile in the micro businesses, I think their needs are like consumer. Their needs are like very small in nature. When I say consumer, their needs are very small. So they might need a 50,000 rupees loan, or they might need a 1 lakh or 2 lakh rupees loan, and not. And there's no one size which fits all. You need to, depending on the different customer segment, different industry segment, different ticket segment or sizes, we need to have a differentiated underwriting models and different data which flows into the scorecards. So I believe, and I just want to share with you that we have built a B2B platform, Udyog Plus, on which we encourage small businesses to come on the platform. And we have built scorecards and models, and we underwrite them for small ticket loans and provide them. And we want these small businesses to grow with them as they grow big in their businesses. So starting very small and then grow along with us. So that's the need of the hour, because most of these businesses are very, very small, and their cash flows and their established in balance sheets are somewhat fuzzy. You will have to derive a lot of comfort through other means in terms of other data, other scorecards.
So I think this common theme is coming through. What I'm hearing is segment your customers and segment them really to the level of understanding their needs separately. Don't take a one-size-fits-all approach. Every segment, from an underwriting perspective, from a proposition perspective, they all are going to look different, and it is going to be hybrid, because all signals you will not capture from data, especially when it comes to business. I was having a conversation with Bhavesh, and very interestingly, we were discussing about how NTC in retail is kind of coming down, but NTCs in MSMEs continue to stay a good 40%. This is the number that Mr. Rajgopalan also was sharing. So, with that kind of opportunity coming through, Bhavesh, how are you seeing the bureau signals there?
So, I'll just, all the panelists spoke about how retail has grown over last decade, and where MSMEs, I'll just give some bureau-based stats. So right now we have 65 crore individual information reported on the consumer bureau side, out of which 26 crores are credit active. Means they have one trade line which they are paying on a regular basis. Now, when you compare this with commercial bureau, we have around 3.6 crore reported to commercial bureau. And if I take the benchmark, I say 7 crore MSMEs in the country. So 50% is the current formal credit penetration which have been ever reported to CIBIL. But out of this 3.6 crore, only 90 lakhs are credit active. So that's point one. And then comparing the new to credit on MSME and retail. So retail side is actually decreasing quarter on quarter. So there were times it used to be around 20-25%, say 5 years back. It has come down to 8 to 10% through the door. On the MSME side, the through the door NTC population is upwards of 40% consistently for last 2 to 3 years. But the opportunity lies in terms of the disbursal of these NTC borrowers, because only 1 out of the 4 NTC borrowers actually been given a line of credit. Now that's significantly lower as compared to a credit tested MSME borrower. Now when we look at the performance, NTC borrowers are not bad. Okay, when I say that a large proportion of the NTC borrowers perform on par with the near prime segment, which is your 4 to 6 CMR. So there are pockets of opportunity here, and the point which all the panelists spoke about is in terms of scorecards and how do you underwrite those micro segment MSME borrowers. So what we have done is actually, with the help of CIBIL, we have based on a segmented approach, look at either an income statement, GST information, or bank statement. We launched the Fit Rank. Now, thanks to UPI, the bank statement is quite rich enough even for a pan wala or a kirana wala. So if a lender has to look at an NTC borrower, basis the volume velocity aspect in the bank statement, you can actually do the risk ranking and tell saying that, are you good enough to entertain this application or not? So that's an important change which is happening. And it's critical that the MSME contribution to the GDP needs to be kept in mind. At the same time, these NTC borrowers need to be brought into the credit fold, because on the retail side, I think so as an industry, we have done fantastically well. I gave some stats. There's a huge opportunity on the MSME side. And also, one needs to look at it that where does the opportunity lie? That the retail borrower is also self-employed. Can the banks, NBFCs look at the retail customer with the lens of MSME? That if you have a borrower who's doing well on a housing loan or a car loan, can that borrower be looked? Because that borrower in an MSME capacity may not have a credit track record. But can you use a combination of individual information, bank statement, GST, income statement, combine it all together and look at even a NTC borrower? So there is a huge opportunity on the NTC side.
Before we move, I want to touch credit towards the credit and delinquency towards the end, and I'll take views. But before we go there, Sabya, one more thought from you would be welcome on how banks and fintechs, how can they collaborate better to deepen, especially the micro side of the business?
Okay. Before I jump into that, I mean, just to add to what Bhavesh was saying, in fact, the next level of the analysis is happening for micro. So let's say one part is to just estimate the income. But the second part is also to estimate the quality of income.
Sorry, estimated?
Quality of income.
Volatility. Yeah.
Right? So if you go a little deep in the bank statement or the GST or the Udyam and the other alternate, you can even figure out what's the quality of income. I think that's very important when you look at NTC, because you are trying to just assess the income and basis which, because there is no past record. So those are available today. As far as there is an open acceptance, I think all this can be rolled out slowly. Also, it is important, let's say I'm a micro SME. Where am I spending? Am I spending to buy raw materials for my stall, or am I spending every day evening in a liquor shop? Would you want to lend? So there are multiple dimensions, behavioral dimensions also, which has started coming up. Whether somebody wants to take that step forward is the question. But data points are available, just to add to that. I mean, I think EPFO, everybody thinks it is important for salaried employees. Who says so? There are more than 10 million on EPFO from an SME perspective. Should we look at that? Of course we should. So I think we have to start thinking very radically different than how we have been thinking from an SME lending perspective. That's the point. Okay, coming to the next point, I think very, very relevant topic. I always associate fintech and banks. There has been talks, rumors, noise throughout the decade that they both are competitors. I never thought so. Personally, because I have traversed this journey. The reason I'm saying so, when we started Perfios and we were there knocking the doors of the banks, obviously we were liked, disliked, not accepted. Today we are. So we have traversed one journey. And I think why I'm mentioning this specifically here, because I think that's how the collaboration should happen. The first is, when we started, we were just treated as a vendor. Come 2015-16, we started being treated as a partner. So it was after about 5-6 years, we started in 2008, I'm talking of 16, so 8 years. Come 2020, we have become pretty much a consultant. So the partner, a vendor to partner to consultant. I think every collaboration between fintech and bank should traverse that journey. You will directly not achieve a status of consultant, where you are discussing the pain areas and trying to solve. Ideally, that's what the state should be. So if that is done, then I think any problem we are discussing today, because the topic is SME, but all problems can be handled in a much better way. Now, when we talk of micro SMEs, I think the first thing is, whom are you partnering with? That means, because bank is the big brother here, let's accept it, okay? Because they are taking the risk, prima facie. So, whom are they onboarding as a partner? Is the experience relevant in that area? Do they understand the space well? Have they dealt with some problem statement or use cases on the micro SME side, whether it is technology or whether it is product domain? If they have, then I think the collaboration will go well, and the problem that we are trying to address from a micro SME perspective can get done. Now, there are different aspects from technology. It can be at an onboarding stage, it can be at a due diligence stage, it can be at a cross-sell, upsell stage, which Rajan mentioned. It can be the most critical part of lending, which is collections. You want to lend, of course, but how do you get the money back? There are technologies, but I think those technologies are mostly trying to bucket your so-called recovery into a different risk zone. But who actually does the hard work in the field to get the money back? I don't think that has been solved completely. I mean, technology has not been able to solve that completely. But I think if these factors are considered while the fintech and banks are collaborating, the partnership will be there, and you will get more better results. That's what I feel. I mean, of course, there are many more things that you need to see the sustainability of the partnership.
Yeah.
Because the bank is investing heavily on a program. It shouldn't be that the partner is fly-by-night operator. Cannot be, right? Or the sustenance is only for 2-3 years. Because you want to make the program successful when we are talking of collaboration. That's what I feel.
Okay, now a very pertinent part around customer stress and delinquency. Maybe I can start with Mr. Rajgopal here. Sir, if we look at the delinquencies on the books, on the one part is on the PSB side, but also the other part on the micro side are elevated. Is it the cost of driving entrepreneurship in this country?
Yes, of course. Because you have, you cannot actually, unless you try, you cannot build the model, as simple as that. You cannot simply conceive a model and say it will become successful, it will not. So we'll have to keep on trying. So we have, as you rightly said, most of them. So you have models which have been built over a period of time because of the experience that we have gained. So delinquency is an issue in MSME, and it is not new. It has been there for so many years now. So I have been in this business for 32 years now. So I have seen bigger delinquencies than this even in MSME sector. It continues to be like that, but we should know how to handle it, how to actually kind of manage that better, and what level of delinquencies are acceptable to us from the point of view of risk appetite is something that we have to think at the organizational level. Now that is one point. Another point is how do we handle this? So there is a structural problem. I see that as a structural problem in terms of how we actually look at the entire loan life cycle of MSMEs. So there is a lot of bundling that happens in most of the banks. PSBs, of course, it's much more. So basically, the problem is sourcing and then due diligence, basically identity verification of the customer, which Sabyasachi was talking about, and thereafter onboarding them, and then underwriting, and thereafter collections, and then dispute resolution. These are all handled at one level, and they are not actually, there is nothing happening in terms of areas where we can actually strengthen this process. Everybody talks about underwriting. So the point is, all these processes have to be unbundled. That's what if you look at the whole Woken network that Nandan Nilekani has been talking, he is talking of actually democratization of credit. Democratization of credit can happen only when there is a democratization of data. So democratization of data means data requirement at each level is different. So you have to unbundle all this and create very good kind of excellence there so that our risk management becomes better. Risk management for MSME cannot be kind of umbrella type. It has to be very, very clearly identified at different processes. Then you can have an umbrella type. So this is what is, that's how you manage the stress. So that we are all discovering as of now. Maybe another 2-3 years down the line, considering that a lot of surrogate data is available, we'll be able to figure this out better. So then naturally there will be a lot of improvement in terms of stress. If you look at, I was really surprised at the, if you look at the annual report of RBI, the stress levels of cooperative banks are much less than public sector banks and others. They also do a lot of lending to MSME. They almost have 6% share in the MSME universe from the cooperative banks. Their stress levels are much less than compared to others. How do they do it? Maybe because of Connect, they are able to do it better, I don't know. So that we'll have to find out and see how we can actually do this better. Where, as rightly said by Rakesh, so it should be a phygital model where we actually adopt both physical as well as digital in terms of managing this process differently. So my idea is basically if you want to manage stress in MSME, don't get stressed with stress in MSME, try to unbundle the entire process.
And maybe this is my last question, and Rakesh, this is to you, but Rajan, any other panelists, feel free to jump in. As an industry, how do we build a better credit culture when it comes to MSMEs? This is being done very actively on the retail side. We are hoping that those messages go through. But how do we build a credit culture, and also how do we help the right MSMEs, with the right intent, when they're stressed? What should the industry's approach be?
So going back to what Bhavesh mentioned in terms of deepening and strengthening of the credit bureau, because on the consumer side, people know that once they have defaulted, they will not be able to borrow it again. So I think that culture in terms of discipline has evolved over a period of time, and here also on the commercial bureau, it will evolve over a period of time. See, it's just not about MSME. Any lending which you do, I think getting stress in that portfolio will create a lot of stress for all of us sitting on this platform. So, and what we do is, in lending, you give loan for 2 years. If it's a secured loan, 10, 12 years. If it's a home loan, 20 years. And you look at the cash flow of the individual or the entity right now. Can you predict what will be the cash flow 3 years down the line, 5 years down the line? You don't. So that's the reason I think our models have to be strong enough. It has to evolve over a period of time. Our scorecards, our underwriting models. And today there is so much of discussion around stress in unsecured lending. That's on the consumer side. So similarly, on the MSME, so we have to price for risk. We need to have a strong collection mechanism. When I say strong, does not mean you go and hound the customer, but in terms of I think predictive models in terms of where we can go and
the monitoring aspect that Rajan was talking about.
Yeah,
how do you monitor?
Just monitor, early monitoring and all of that, early warning signals, whenever, and awareness, a lot of awareness. I think Ajay had mentioned in his opening remark that awareness, making them aware that if they have to come back and continue to take debt from any institution, they have to have that discipline. So I think a combination of all of this is what is needed to strengthen the behavior.
Anyone else?
Yeah, Joe, I'll just add to what Rakesh mentioned in terms of we are working with financial institutions to create a credit education sort of culture within the country. On the consumer side, I think so there's a good amount of awareness and consciousness that you need to pay on time. You need to have a good credit history. You need to have a good CIBIL score. Same we need to do as an industry is educate these MSMEs. One is in terms of getting them access to formal credit sector. Second is ensuring that they feel comfortable that not just in terms of business cycle based, but they pay on a regular basis and instill that culture of responsible credit sahi hai. That dukandar or that MSME needs to be educated consistently.
I only want to make one point which is very important because generally whenever we speak about MSME, people speak about the opportunity available, the growth potential, NTC and whatnot. Unlike lending, the MSME is also instrumental in structural development of the country. And hence, this has to be the most responsible kind of lending by the lenders, right? So instead of looking at the kind of opportunity and the kind of growth which you can see, once the banks create an impression that it's a toxic segment because of the faults which they do, that can give a bad name to this industry. Hence, it's very important that when you're dealing with this segment, it's a highly remunerative segment. There are a lot of cross-sell opportunities available. But this also has to come with the responsibility to ensure that you apply all prudence, whether it comes to underwriting, whether it comes to whether it comes to your product selection, whether it comes to your collection machinery, whether it comes to education of to the customer in terms of applying the right measures to collect or to pull him out of the delinquency. It's a very responsible lending. Today, if India has to really go for that dream of 30 trillion and 45 trillion, whatever numbers we throw in the air, it's important that we do this lending with a lot of responsibility and hence manage and maintain the prudence which is required in extending this segment.
Here we are at the end of the panel. There may be time for 2 or max 3 questions if there are from the audience here.
Good evening. Hello. Yeah, hello. My name is Muralidharan. I'm from Hyderabad. I run MSMEs. I run multiple MSMEs. So I want to talk from the MSME standpoint. All of you are talking from the banking standpoint. 2 things I want to highlight. I've run multiple MSMEs, multiple banks. Fundamentally, I think one of the points made here was MSME is a special segment. You cannot extrapolate your experience from consumer banking or from large-scale banking. The first thing is MSMEs don't want transaction banking. We want partnership banking. What does it mean? Transaction banking is all about when you come to the bank, the first question is, what do you want? What loan do you want? What do you want to do? It's not the question. The question is, if you're a partnership mindset, what business are you in? How can we help you? Which is the business? Where is it growing? What kind of growth capital you need? This kind of conversation we don't sign at all. So we are talking nice things about banking, but we don't understand the MSMEs are not looking for concessional loans. We are not looking for low cost of funding. We are not looking for speed of lending, which is what fintech gives. We don't want any of them. What we want is responsible banking and a partnership banking. Partnership banking means sit down with me, and maybe we need intermediation because the bank doesn't have capacity to provide this kind of consulting. So why can't we have intermediation? If you have intermediation for a home loan, you have an agent for a home loan, you have a personal loan agent, how come we don't have an agent for a MSME loan, which sit with especially micro and small industry? For example, one example I'll give you, onboarding. The worst onboarding you can get is only for MSMEs. I've worked with 5 banks. Not a bank has called me and spent 2 days in a training center. You train employees. You don't train the bank or promoters of MSME to say what kind of facilities are available, what kind of products we have, how can we help you, where did we go? There's hardly any onboarding at all, 0 onboarding. So I think you need to change your mindset from transaction banking to responsible partnership banking, and that requires a completely new shift. And last point I want to say that I think MSMEs are the job creators in this country. So all of us, the banks, have to realize if we don't create employment, there's no demand in this country, and therefore we provide a lot of services to the entire banking industry to increase consumption. Thank you.
Thank you. Any questions?
Financial institutions always are looking for credit worthiness. But can I ask any panelist, last 10 years, you had seen the balance sheet, but whether you had seen any, your customer or visited the 10 customers to look at their factories. I'm talking about the industry perspective, to visit their factories, what is their, I say, pain, gain and contribution. Either that is a struggling company or either that is a growing company. I want to hear from Mr. Rajagopalan on notes.
So we have been looking at it. For that, our friend over there who has actually given good suggestion. At our bank, we have credit counselors. We have quite a number, around 250 plus credit counselors are there who give you idea as to what, because this is a good idea which I have actually picked up from some of the chambers of commerce I have visited. They said that you need them to understand how to manage their cash flows and credit, so you need to advise them. So we have created that ecosystem within the bank. Of course, it's maturing very well, that I can say. And so far as your point is concerned, we are not present greatly in medium segment because none of the public sector banks has great presence there. No, we are mostly into micro and small enterprises. So we do take care of small and micro enterprises very well and go there. And if you look at the proportion of lending in our book, it is actually 50-50 in terms of manufacturing and services. So wherever manufacturing is there, we do go and visit and see how they are doing their businesses, because inspection is one of the important things that we do. We do a lot of outreach programs in terms of bringing on those customers and doing that. So that's what we have been doing on a continuous basis. As in terms of credit worthiness, it is a debatable issue. We can keep on, what is credit worthy today may not be credit worthy tomorrow. What is credit worthy yesterday is not credit worthy today. So it all depends on, there are a lot of subjectivity over there. So I don't want to get into that credit worthiness aspect of the businesses, because it is basically a kind of how you cater to them, how you are close to them, and in terms of doing all that is how it matters. So we actually service almost all segments of the micro and small. So naturally, we are in touch with them. And we have, as rightly pointed out Mayank, we have more physical outreach than digital outreach. So our connect to the customer in touch the ground level is much more. That's what my point is.
About last question, the credit bureau. If the financial institution will not provide you the proper data on time, and if any entrepreneur reject their loan, who will be responsible?
So RBI recently, in fact in April effective, have defined the roles of CIs and the CICs and defined the timeline within which credit institutions need to give data to CICs like us, and how much time each of the entity in the ecosystem, whether CI or CICs, need to revert, resolve, and go back to the consumer. So it's a very progressive step taken by the regulator where everything is defined, and at the same time there are even penalties associated. So if any of the entities associated in that entire consumer chain, then there are penalties defined. So I think so it's a very progressive step taken to ensure the consumer's rights are protected.
Thank you all the panelists for a great conversation. That concludes the panel discussion. Thank you very much.
Thank you all dignitaries. Ladies and gentlemen, we will take 5 minutes to reset the dice for the next session. Thank you, sir. I request all to please take seat as we are starting our session 4. May I request all to take seat as we are starting our session 4. I request all to please take seat. Ladies and gentlemen, I am pleased to announce our 4th session on Risk and Compliance, Embracing for Emerging Risk and Regulatory Complexity. I am pleased to invite the panelists to the dais. Mr. Rajiv Savarwal, MD and CEO Tata Capital, Mr. Sudipta Roy, MD and CEO L&T Finance, Mr. Gaurav Gupta, CEO QNB India, Mr. Parag Bise, Executive Director and CEO Nucleus Software, Mr. Jitesh Khaitan, Head SAS India. And our moderator for this session is Mr. Hardik Shah, MD and Partner BCG. May I request Mr. Hardik to initiate the discussion? Over to you, sir. I request all to please take seats.
Good afternoon, everyone. If you can please take the seats. Can I request everyone to take the seats, please? it's working.
I request all to please take seat. We are starting our session 4.
All right. Good afternoon, everyone. We've got a very esteemed panel and a very diverse set of experiences on the topic of risk and compliance. So we'll get started right away. Gaurav, here I can start with you. You operate in some of the toughest and the high-risk markets in the world. What is your experience, as far as operational risk is concerned? How have you seen the evolution, and what are your top 3 priorities when you look at these markets?
Good afternoon, everybody. First, let me clarify why Hardik calls us operating in some of the toughest markets in the world. So, a lot of you already know Qatar National Bank, but did you know that QNB has now become the largest bank in the Middle East and Africa by all balance sheet metrics? And the bank operates, of course it operates in Middle East and Africa, but it is also regulated in all the large international financial centers like Singapore, Hong Kong, London and Paris. Recently, the bank got ranked the world's best bank for emerging markets. And despite operating in all these markets, it has an international credit rating of AA and is ranked amongst the world's safest banks. So it must be doing something right. But when we sit around the table with our colleagues from different countries, I think one of the things we all agree on is the rapid pace of technological transformation. And across countries, settlements are becoming shorter, payments are becoming faster, things are, there's STP, straight through processing, and also because of that, the possibility of propagation of errors has also become real time, right? Because it's easy to now move data and securities and a large amounts of that at very short notice with the improving connectivity. So I think operational risk has become one of the key risks which banks are looking out for. And the 3 which stand out for us the most, the first has become information risk. Then there is the risk of IT disruption. And thirdly, the third-party providers, the third-party service providers. And if you see over the last few years, I mean, how you look at the risks and how you classify them in terms of priority has also changed. Many years ago, the big risk was the risk of theft, whereas now the risk of theft of funds has become a lower order risk. And I think information security is right at the top. The possibility of, especially we talk about AI, and because of AI, it further exacerbates the risk from the cyber risks. Banks around the world, I think the bill for cyber security is more than $300 billion of banks around the world. So, the risk of theft of data from the banks, the risk of the data being manipulated, and the risk of data being used for the purpose that it was not intended for has increased significantly. So I think information security risk is extremely critical. The other is, when we talk of, like if you look at especially in the retail sector, as compared to, I spoke about the theft of funds. Now, you compare that, now theft of funds is something that you can quantify, you can insure against it. But what about things like if you're a retail organization and the customers are not able to access their account for 1 week? So I think the risk of IT disruption and the risk of that happening, therefore, is a key risk. One, it causes reputational damage. And secondly, it causes opportunity loss from lost income. And that can be much more damaging than even a theft of funds. Then finally, in terms of, a key risk which has become important this year, and it's escalated in terms of its severity, is the risk from third-party service providers. So as the banks are becoming, banks are of course becoming more efficient, and they're also leaning on their service providers to further enhance the efficiency levels. Then the banks have also increased the standards they expect of their vendors. So of course, very few vendors qualify for those standards, and more vendors are banking more and more, lesser number of vendors are banking more large institutions. So the data warehousing in a limited number of vendors has increased. So if you look at the cyber attacks in the last 1 year, a lot of, say, the cyber actors, instead of attacking the financial institutions themselves, they will attack the third-party providers who are warehousing a lot of the data from the large banks. So I think these are some of the key risks that we are seeing in the operational risk space.
Many great points, and we'll touch upon all of them, especially we've got 2 technology solution providers on the panel as well. But Sudipta, if I can come to you next, from global geographies closer home, you've spoken a lot about how there is a spectrum of risk in the geographies within India, right? And as being the largest small ticket lender in this space, given MFI, two-wheeler, consumer loan, all of these, products that you actually look at, how has your experience been assessing risk amongst different geographies?
Yeah, thank you for the opportunity, Hardik. And one of the things I'd like to say is that, I look at urban risk and rural risk separately. And if I were to sort of, and it always helps if you put it in, 2x2 quadrants. So the way I look at and I classify products as financial services products, I classify as dynamic products. That means products that have high velocity, right? Like payments, or for example, OD. Lot of transactions, up and down it's going, or for example, credit cards, right? Which is like a payments with a lending product combined. So I classify that as dynamic products, and static products are primarily loans. They're static loans which you service and amortize over a period of time for the customer. And on the other quadrant, if you have urban markets and rural markets still, especially in India, are not, apart from payments, which is through UPI payments, they're not really capacitized in terms of market maturity to handle dynamic products. So if you see, most of the rural lending that happens is static product lending that is happening. Well, the urban markets are actually capacitized to handle both dynamic and static products. But in terms of the movement of risk or assessment of risk, one of the things that you have to always keep in mind when you are measuring both these markets differently is that urban risks move slowly. Rural risk at some point can move very, very fast. Right? Because in the rural areas, you have to keep in mind that when you lend in rural areas, in urban areas, you lend to an individual, right? Or you lend to a max if you're lending to a company or lending to a group of individuals, right? In rural areas, you're actually lending to an individual. If you're doing individuals, you're actually lending to an ecosystem, right? And sometimes that ecosystem can bring in risks which obviously you do not budget for. For example, when you look at rural lending, for example, we are now the largest tractor lenders in the country. And the fact is that the density and the distribution of rainfall have an outsized impact on how the risk on your portfolio pans out. Now, obviously, in rural areas, you have climate risk. You might at times have political risk, right, which is a cloud over your portfolio. And I'll give you, or you might have risks which is like completely out of the blue. And I'll give you an example. A couple of years back, about 4 or 5 years back, MFI portfolio in Odisha specifically, a rumor spread that of the demise of the CEO of L&T Finance. And the fact is that rumor spread so fast that almost close to half of the sort of the villages which were being serviced by us, people stopped paying. But the fact is that is a risk that you really do not budget for. So I think, when you are underwriting rural customers, especially in the MFI space, in the tractor space, or other rural allied products, I think you have to be far, far more cognizant of the sort of the unforeseen risk that comes out and keep your margin and safety to that extent. And that is why listening posts, what we call listening posts closer to the ground, is very, very important. Urban risks these days, you can run with a lot of data. There's a lot of data available, both the bureaus. Rural risk also now you have bureaus available. But the fact is that the certainty with which you can run urban risk or urban products right now, I think rural products still have a long way to go. And the only way to manage rural risk is to have a data overlay, but have physical overlay. You know, what we call human, you know, in terms of, espionage term, you really have to have human intelligence on ground to actually estimate the rural risk and feed it up the chain. If you don't have that, you will fall into the ditch.
That's a great point, because I think over the years, there is this trend of, how do you increase digitization? How do you get to STP lending and remove the human overlay, right? And Rajiv, if I can come to you, the flip side of, doing more digitization is there is an incidence of application fraud that keeps rising. There are unintended consequences around it. How do you look at this, and what has your experience been on this front?
I think, as lenders, we keep evolving. So do fraudsters. They also keep evolving in this whole journey. And the only thing which I have learned over a period of time is how do you build resilience in your system? How do you ensure that ops risk is managed well? For a long period of time, we have always focused on credit risk as one of the most important risks. And it was true also. But over a period of time, one has realized that ops risk is becoming a significant part of the total risk. And this is the reason, if you would notice, RBI brought in a separate guidelines for NBFCs to bring focus on ops risk and outsourcing risk going forward. All of us moved towards digitizing all our products. Everybody wanted to create digital journeys, ensure that all loans can be given out with, forget low touch, zero touch models. But what one is realizing that, the more digital you make the process, it's very, very important that you build in a lot of controls within those journeys. And if you err on the same, then you make your system susceptible to frauds. There are many ways of resolving it, because I always believe in the long run, creating frictionless journeys is very important. Creating more digital journeys is very important. But how do you parallelly work towards making the, these journeys more risk-free and avoid any challenges? I think one important way is to use the digital infrastructure which has been created within the economy. I think we are still a step away from allowing and treating all entities in the same manner in terms of allowing eKYC. Certain institutions get certain priority in terms of their ability to do eKYC, while other institutions are still struggling to get an okay from requisite authorities to do eKYC. I think some of these anomalies we have to find a way of removing, because infrastructure should be common for all lenders. There should be no differentiation there. How people use it could be different, but ability of that infrastructure to exist for all lenders should exist. Similarly, we have to find a way of seamlessly sharing fraudulent partners, fraudulent entities and information on them, fraudulent employees, and so on. We have to find a seamless way of sharing this information, because allowing for a strong infrastructure to enable KYC, allowing for negative information to be shared is in the interest of the whole ecosystem. I think if you do that, we will try reducing, we will end up reducing some of these operational challenges. The other is, I think as lenders, all of us have to think that is there a need to introduce a physical leg in all digital journeys at some stage so that we can avoid people who infiltrate or, bring about interventions in the digital processes. So I think we all need to decide for which product, what we need to do there. But if we can create an infrastructure where, all available information on frauds as well as ability to do KYC can be common across all entities, it will support the system.
Very interesting. So there's credit risk, we've spoken about operations risk. One other big theme that's emerging, at least in a lot of the countries in India as well, is RegTech. And, Parag, we've spoken about it as a technology solution provider. You help financial institutions be on the right side of compliance or on the side of caution. How do you actually think about the technology infrastructure and the agility with which, FIs can implement some of these regulatory compliances? And what has your experience been?
So thanks, Alec. Yeah, I agree that at least recently the speed of regulatory changes has really increased. Frankly speaking, we did face a struggle initially because one is the speed, and second, we also realized that different customers, thankfully we have a lot of customers, but then everyone, or if not everyone, they had different interpretations of the same regulation, and they wanted us to implement the solution in different ways. So that created a struggle for us. Of course, what we have done now is we found a common team. This team looks at the regulations that are coming in. They try to understand it, and whatever is relevant for us, try to create a standardized solution. So thankfully, we have a standardized product, and if we are proactive enough, I think we are in a position to provide a solution to our customers much before it is needed. We in fact also have reached out to the regulator to see if we can be involved at an early stage, where we can understand from them what are they thinking and are able to design the solution proactively. But that's the thought process, that's the direction, there's a long way to go there. You talked about RegTech. I think two areas where RegTech comes into picture, that's my personal opinion. One is the standardization, because there could be, for instance, one of the things that is there now is the key fact statement, so that everyone has to provide. Now, a RegTech solution can be there, and that's what we've seen in some advanced market, that the data is sent to that solution and they create report, or they check the transactions, or you send the transaction to them and they check and give you a value or a score or whatever. So that's how those are the basic thoughts. And of course, what's very important is the speed you talked about. The architecture of the solution has to be such that making changes is easier. An example that comes to my mind is when the COVID struck, and then when there was a need to provide the moratorium, and we were required to do that for hundreds of customers within weeks. And thanks to the solution that we had, which was configurable and hence was able to provide flexibility, it was possible for us to attend to that requirement pretty fast in a couple of weeks or maximum couple of months. So these things become very important, I think.
Got it. If I just continue on the theme of regulatory changes, and Jitesh, if I can, call you in. there have been a lot of changes and a lot of proposed changes in the regulatory environment. There's ECL norms, there's climate risk, there is, this liquidity risk, guidelines. How have you seen, and given that you've seen the global market, you've seen India, how do you see the difference in what has been the experience of Indian financial institutions in implementing or, managing the pace of these changes?
Thanks, Adik. Good afternoon, everyone. So we have seen quite a bit of changes in regulatory environment in India. Yes. Am I audible? Yeah. So we have seen quite a bit of changes in the regulatory landscape in India. But we also have to see from the perspective that the banking and financial sector has been growing. There has been reduction in NPA, there has been growth in profitability, capital, etc. It's there. So broadly, what we are seeing is this regulatory evolution is required for financial stability. This is required for financial stability perspective and also for fostering of growth in the sector. And RBI has been very proactive in this aspect. We see three key drivers for regulatory change, where regulator is responding to macroeconomic fundamentals, some of the policy directives, which is there. Secondly, what we see is where there is required to be an alignment with the global regulation. And thirdly, where regulator is trying to strengthen risk management, compliance, etc. within the financial sector. So if you look at from this perspective, there has been changes to liquidity, there has been changes to risk weights and all. A couple of years back, I think so, there has been a tier-based regulation for NBFC, which has been brought on due to increased, importance of NBFC in this sector. In terms of harmonization to global standards, there's a lot of work happening in IFRS 9, IFRS 17. IFRS 9 has been implemented in NBFC, but it's, it's going, the final guidelines for ECL are going to be released for India for banking. And there would be a lot of focus on model risk management in that, which is not still there to that level in case of, from an NBFC perspective. And there are a lot of guidelines which have come in to, strengthen risk management and compliance. So you have been guidelines on operational risk management, servers talking about third-party risk management, cyber risk, information security risk, operational risk resilience. There has been guidelines on compliance automation. There has been, guidelines on, draft guidelines on model risk management. So a lot of these guidelines, there have been recently changes to fraud risk management guideline where, EWS focus has shifted from just, not just loan to all other facilities. So there's been a lot of changes to strengthen it. And all this is required to, maintain the financial stability from that perspective. The other thing I think so what you ask about is how can, banks and financial institutions adapt to these changes and how they are doing it. So there are two or three things, banks or financial institutions which have to adapt to changes. They do it well. First thing, they keep themselves abreast of all the changes, what is happening, what they need to prepare. And sometimes regulatory expectation from each of the regulated entity is not the same. It is different. So you need to be aware. They invest in people. There's a lot of attrition risk in this thing. You need to specialize, upskill, train people. That is there. Third thing is what they also do is they do their scenarios, they do their stress testing to understand the impact of this regulatory changes on their portfolio and their operation. And the fourth and most important thing, they invest in technology. The technology which is agile enough to adapt to these changes in quick time. So that's what we are seeing from a technology perspective.
Got it. And you mentioned.
No, but just to add, while there's so much technology going around, and all the banks are investing so heavily. So I think you also asked how are, and Jitesh answered, how are banks equipping themselves, right? So one of the interesting things around the world is that banks are going to the tool which, the old-fashioned tool, which is a telephone. So increasingly, and we see this around the world, so when customers initiate a transaction, of course, all the email and the straight-through processing and all of that is there. Banks are asking their staff to make a phone call to the customers in person to verify the transactions, and especially where account changes are involved. So just to say that while we are moving ahead in technology, we are also, there's this manual physical element which is coming center stage now. So increasingly, and not here or there, but across geographies.
Can I ask you a question? I recently saw a report which BCG had brought about about the tech spends of banks in India versus outside the world. And it talked about that India spends about 5% of its of the OPEX. Of the revenue,
Yeah.
and globally banks spend 7 to 8%. Do you think this is a right indicator of evaluating? And two is, do you think globally banks who spend more have lesser ops risk and lesser credit risk compared to banks which spend less? Do you generally believe India is spending lesser?
So I wasn't expecting a question for myself, but I'm happy to answer. So yes, our report actually says that, Indian banks are spending about 4 to 5% of the revenue versus, the global banks are spending about 8 to 9. I think the difference is, and that's what we've, looked at the comparison. The difference is, if you look at the, run the bank spend, it's more or less similar. I think it's the change the bank spend that's, materially different for us versus the global peers. So that's where I think a lot more can be done. I think, global banks have taken the step forward in terms of adopting Gen AI, in terms of being a lot more on analytics. I think analytics is being used differently in India versus the global banks. Global banks use a lot more analytics on the risk side, on the compliance side, on fraud, AML, monitoring. I think we've used a lot more analytics on the credit side, and we are far superior on the analytics side on the credit risk front. So that's where I think the difference is.
I think also that has to do with the replacement of a lot of the old technology of a lot of the legacy banks in West has. Indian, if you see the tech stack of the banks is about 15 years, max 20 years old. Some of the banks in US have 40-year-old technology.
Yeah, that's the other difference.
That is also the legacy replacement, also high cost.
Yeah, and that's also one of the reasons, and the previous panel, someone mentioned about it. The ease of integration of fintechs with the current, legacy institutions or banks is much more easier compared to, global institutions. So even though fintechs are, 5 years, 10 years, ahead of time than the legacy banks, it's still far more superior and easier to integrate compared to the global experience.
True, true. And also, if you see, the global banks are far more internationalized than Indian banks. So IMF said that last year alone, in 2023, there were 3,000 new trade regulations. 3,000. So I mean, it's obviously humanly impossible to keep up with them. So when you're operating in different geographies, different compliances, different regulators, I mean, it all adds up.
Well, if I can just continue with you, and I think Jitesh mentioned an interesting point. I think technology is important, but equally important is the talent front, right? And you gave me an interesting fact about some survey. Would be happy to, share that. But what's your experience in terms of building the right risk and compliance function in banks, and how are they, evolving in terms of not being a back office support function, but taking center stage in a lot more institutions now?
So, of course, one is, there's a technology aspect, but just focusing, so what's happened, and I've seen it, during the course of my career, is that the risk and compliance have, like you said, they become center stage. They have a voice, and they are, they have sometimes the loudest voice in the room when you are taking credit decisions and so on. So as far as risk goes, the biggest change that has happened, I think, is to do with independence. And again, this is uniform across geographies, across continents in different countries, that the risk function is being given the independence to make decisions, so that is on the risk side. And on the compliance side, similarly, compliance is now, I mean, it's almost in every bank, they have to have the freedom to be able to ensure compliance. And it's also been made a joint responsibility. It's not just the responsibility of compliance. So this compliance culture, all regulators are talking about the tone from the top, and the board gets involved in the compliance, and the compliance policies have to be board approved. So with all of that, I think risk and compliance, of course, they're critical, but they also are participating and doing a lot of the heavy lifting in the decision making.
If I can ask one question, I think, a lot has been said about regulatory, compliance, risk as being, a tick mark that has to be done, something that needs to be done. But then there is also real balance sheet or a revenue opportunity. Climate risk can be viewed as a compliance or a risk management tool, but it can also be looked as a real business opportunity to be baked into the pricing, the underwriting, and also open new pools of, financing. And you've had a, very good run in terms of building the, green finance portfolio. What, if there's any learnings that you can share with the rest of the...
I think you raise a very important point, and I think building climate risk or ESG has to still take center stage in India. While we all talk about it, I think there is an realization has also dawned on entities, but I think it is at different stages of evolution in different organizations. We started this journey long back, and we started this journey because we had partnered, IFC was and is our equity partner in the organization, and they have an excellent framework to assess climate risk and related ESG risks. And what we realized was that like we evaluate credit risk, ops risk in every transaction or every proposal, I think we created a policy to also evaluate climate risk or anything related to that for every transaction. And so for every transaction in certain parts of our business, we started also evaluating where does the transaction stand in terms of its impact on climate risk. Based on what we got as an output, we created different governance structures in terms of evaluating the transaction and monitoring it over the life of the transaction. It also led to a situation where we stopped looking at certain transactions. Also, it led to a situation where our funding got delayed in certain transactions because we wanted the client to bring about that change in the way the client was setting up the unit before we started funding the project. So I think somewhere we have to make it as one element which needs to be checked and evaluated like we do credit risk or ops risk or some of the other IT risks in transactions, and based on which we need to decide the way forward. And that is something which we are trying to take forward in all transactions within the organization. Your other point on can we really differentiate on pricing? Because if you look at, transactions for banks or lenders, the risk on climate, on what they do is very little, but it is more about the projects which they fund. But India is a very, very competitive market, extremely competitive. Sometimes we wonder whether lenders fully factor in all the risks before they price the transaction. So in such a scenario, to build a differentiation on account of this on pricing is tough. While we try to do, but it is tough, to be honest. And I think we as an industry have to evolve to coming to that stage and factoring in climate risk in our pricing also. So while in terms of evaluation, we are doing it, but in terms of pricing, I think we are finding it really tough to do that.
But it's interesting, you need to embed, sorry, Gaurav, you have a point.
No, I just wanted to mention on the international loans, when you are lending, say, in foreign currency, there now the banks have moved to risk-based pricing. I mean, so you have something called sustainability-linked loans. And when you have sustainability-linked loans, you can agree KPIs with the borrower so that if they meet the certain KPIs with respect to emissions or reduction, carbon reduction, and so on, then the pricing comes down actually. So in that sense, you are seeing that internationally, and it is only a matter of time. I think it will come to India also.
You raise an important point. How do you embed the risk management practices across all the different functions, right? Whether it's credit, whether it's monitoring, pricing, all of them. And Sudipta, we were discussing about this. You've been very passionate about building a risk and compliance culture in the organization. If you can share some thoughts around that.
So I think the most important part about building a risk and compliance culture within the organization is, first thing is the tone at the top. In the sense that what is your senior management team, including the CEO and the, sort of the board members, talking down to the entire team, and the fact is that is the organization's sole objective is, revenue growth and only top line growth, or is the organization's objective is balanced growth which takes risk into account? So in a way, is the top management saying that, risk is our middle name, basically? What this, first thing is tone at the top. The second thing is that sort of propagating a sort of a sensitization of, and obviously risk we have, credit risk, reputation risk, ops risk. Yeah, ops risk, then we have climate risk, as you asked. Now one of the issues that we have is that at many times the risk, especially the credit risk and the risk teams are sometimes a little detached from the rest of the organization. At times, I would not like use the word secretive, but they're a little detached. One of the ways of doing this is to mainstream this organization, right? And mainstream the risk and compliance organizations. And one of the ways of doing it is that when you are doing risk, credit risk, cybersecurity risk, ops risk, climate risk projects, induct people from business into those projects, make it as much cross-functional as possible, so that there's a cross-pollination of risk, that sort of the risk culture or the risk sensitization that happens across the system. Third thing, you only understand risks when your skin gets burnt. That is the real way when real managers understand risk, when you actually go through a situation yourself. Now, one of the ways is that, but it is difficult to sort of, especially for younger managers, it is difficult for them to get the full grasp of risk, right? And many of them are top-line driven, many of them are, especially managers in distribution. One of the ways to do that is to do risk simulation exercises, right? And that gives them because still I find that many people still, after many years in banking and financial services, do not assimilate the fact that banking is an adverse ratio business, right? And simulation exercises actually go a long way in sort of sensitizing those young managers about risk. And last but not the least is avoid an adversarial culture. The senior management always needs to avoid an adversarial culture with the group of people who are interested in managing risk in the organization. It has to be, they should say business, risk and business go hand in hand. Actually, they're parts of the same P&L. Right? So as long as that is made very, very clear, I think it goes to build a risk culture in the organization very, very strongly.
Yeah, and I think you mentioned it right. I think credit risk, fraud risk, operations risk, a lot of this can be merged alongside the business teams, right? I think there's one potential area of risk, cyber risk, which is still not viewed as a business priority. Parag, if I can come to you and, if you can share light, how do you see this as a technology solution provider? Do you still see this as a CISO and an IT priority, or are you starting to see that become a business priority as well?
Hello. Yeah, definitely. I'll say not seen it as a business priority yet myself, because these do not come up in discussion so often. Except when there is a compliance or some challenge happens. But I want to make a couple of points. What really worries us because we've been there in this field for more than 3 decades. And today it's a very, very connected world. You know, the number of integrations that we used to have a couple of decades back was very handful. But today I think we are connected with 40 plus fintechs because that's what the customers expect us to do. And it does give the business value. But in matters of cyber security and all, we all know that we are as good as the weakest link. So even if one player is not complying or there is a challenge, the entire ecosystem can be impacted. Adding to it, this is the speed at which now things are expected to be done. We talked about the speed of changes, of the regulatory changes, even the business competitiveness increasing. So, in fact, a lot of time we are asked to move fast, deliver things faster. And while we are looking at that, how to increase the speed of our releases, but again, what adds to the worry is that speed at which we are moving. Are there some shortcuts being taken? And because the world is so connected today, it is really, so I think this needs definitely a far more serious discussion. I don't know what happens, but I'm told that in developed markets now, cybersecurity risk is definitely an agenda on the board meetings. It must be happening here. I don't know what happens here, but I think that's the kind of importance that needs to be given to this.
I'm mindful of time. Jitesh, last question before we open up for a couple of audience questions. You've seen the transition of, the analytics models from being, basic to, very advanced AI models. Are you starting to see that Gen AI is playing an important role on the risk and compliance side as well? We've seen that a lot happening on the customer experience side. We've seen that happening on the marketing side. Are you seeing Gen AI being an important enabler for risk and compliance as well?
So we have seen a lot of Gen AI use cases emerging in risk management. We particularly in SaaS believe Gen AI can revolutionize risk management. So in multiple ways, you look into three ways basically how Gen AI can impact risk management is, first, the kind of value it brings to, data mining. So, traditional search engines, you search and they give you a list. But here with Gen AI, you get curated, precise answers. So just see the importance. You can monitor your internal and external data. It can give you curated information. It can give alert in real time based on that data analysis. So its application for cybersecurity, its application for fraud risk, investigation is immense. The second way, Gen AI impacts risk management is it democratizes access to risk data. You need not know a lot of complex algorithm. Anyone sitting can query a database and get an information. A customer analyst can query and get insight into the trends. It can also bring a lot of productivity as far as risk modeling is concerned, converting codes in different language, generating model documentation, and also is helping in generating effective communication, means how you communicate with customer, what offers to give that to your customer. So we have seen a lot of Gen AI use cases emerging. We have seen in Europe, particularly emerging in big way. We have started to see trends in it. India is in its nascent stage there, but we do believe Gen AI will have a lot of impact. And also, one of the other use cases we have seen emerging is generation of synthetic data. In servers talking about simulation, stress testing. So those are some of the use cases which we have seen emerging for Gen AI from a global perspective.
Hardik, what I'll say is that we just filed a patent about 3 weeks back on our Gen AI use cases, which we call Human Lifestyle Index, where for our microloans customers, what we're trying to do is that we've trained the LLMs to actually build a standard of living index in rural households. So we take a picture of the outside of the house, we take a picture of the inside of the house, and then the LLM actually can identify whether there is a refrigerator, whether there is concealed wearing, whether there is a fan, right? Whether it's a painted house, whether it's an open brickwork painted house or a cemented painted house. So we have trained the LLM to do that. And we've just deployed it into production, and it's working really well.
Fantastic. On that note, let me open up to the audience for a couple of questions. If there's anyone.
on using Gen AI in risk management. So one of the issues in Europe that the banks face is explainability. So in the bank, what happens is, if everything is fine, it's good. But when something goes wrong, then you have to explain why you took a particular decision. So with Gen AI, sometimes it's a black box. But of course, you get the right decisions most of the time. But when you don't, you're not able to say why. So that is one challenge that we're also looking to be overcome.
I didn't mention it, but explainable AI is a very key concept. In geographies like Europe and all, there's a lot of focus on that, explainable AI. So we are working with our customers, we are working with our regulators to bring that, explainability to AI. So that is one of the key themes SAS is working with its customers on. So that's.
Fantastic. If there are no further questions, thank you. Okay.
One last question.
Please.
I want to ask about risk. Basically, from what little bit I know about risk, is about not getting the wrong customer, right? All of us spend a lot of time figuring out how not to get the wrong customer. But there's another risk, another error called beta error, where you miss a good customer. How many banks really do research on the customers you missed out, who've gone out and done very well with some other bank? And there is a risk associated with missing out a good customer. Why is it not taken into account when we calculate the overall risk? Thank you.
You've asked a very relevant question. In all banks, there are committees, risk committee, every committee, which evaluates when the case goes bad. But there is no committee which evaluates why credit or risk declined a proposal which later on did well. I have not come across any committee in any bank which does that. So in a way, in certain functions, in certain things, we do it, but I think that has to still evolve. Because the accountability is on both sides, not to allow a bad case to go through, but also not miss out on a good opportunity.
Yeah, as a promoter, very often we make that call, which banks are not doing. When a borrower is a promoter, sometimes he knows when he lends money to a customer, he takes the call that the cost of losing is much more than the cost of benefit. That concept is not coming into the bank side, whereas entrepreneurs, we do it all the time.
In the next session, there are a lot of bankers who will be sitting out here. They will be able to answer this question much better than I can.
All right. On that note, thank you, everyone. Thank you for a great discussion.
Thank you, all dignitaries. Ladies and gentlemen, we will take 5 minutes to reset the dais for the concluding panel discussion for the day. Thank you, sir. Thank you.
Thank you so much.
May I request everyone to please sit it. We are starting our session 5. Ladies and gentlemen, we now come to the fifth and the concluding panel discussion for the day 1 of FIBAC on the topic, Reimagining HR, Unlocking Productivity for the Future. I am pleased to invite the panelists to the dais. Mr. Rajneesh Karnatak, MD and CEO, Bank of India. Mr. N. Kamakodi, MD and CEO, City Union Bank. Mr. R. Subramania Kumar, MD and CEO, RBL Bank. Mr. Kalyan Kumar, ED, Punjab National Bank. Mr. Govind Singh, MD and CEO, Utkarsh Small Finance Bank. Mr. Indrajit Kamotra, MD and CEO, Unity Small Finance Bank. And I request our moderator for this session, Mr. Varun Kejriwal, MD and Partner, BCG, to please come to the dais. I request Mr. Varun to initiate the discussion. Over to you, sir.
Good evening, everyone. Thank you for joining us for this panel discussion. It's the last one of the day. So quite fittingly, we are discussing the most important topic of HR. The idea, and I'll set the context for the panel discussion. So we want to discuss how HR is getting reimagined, and more importantly, how productivity is getting unlocked for the future, and what are the different things that these esteemed bankers are doing to unlock it. Before I delve straight into the questions, I'll set the context for 2 minutes about the panel discussion itself. So this is one area, if you read all the articles that come out about disruption, about AI, about analytics, the two most commonly affected areas are operations and HR. And we did a scan of all the articles that came out, and AI is just one example of the new technology, but the way and the amount of disruption that it is expected to cause within HR in a much more positive way is humongous. So the idea is that how do we then relook at HR and make it more efficient, employee friendly, more employee engaged using this. I just want to throw some data points. Almost half of all Indian companies have started thinking of implementing Gen AI in HR. That is a remarkable statistic. And almost half of them also believe that they are having a shortage of skills when it comes to growing the business. I also want to tell you one more thing. There is 82% organizations, and this was a large survey that we did, who also said we do not have a long-term strategy when it comes to how do we want to use these disruptive technologies. What this tells us is that in HR, there is an appreciation of the fact that this technology will help, but how will it help, what is it that is needed, is still something that is getting evolved. I'll give you some examples, whether it is Gen AI, automation, advanced analytics, agile organization, or simple process improvement. Different banks around the world have taken a stab at leveraging these technologies to improve HR. And as bankers today, we are all at the cusp of this revolution. The idea is to embrace it, to improve different facets. What is it that we are taking away from the world at large? One is Gen AI. As I mentioned, Gen AI, operations and HR are the two most affected areas by Gen AI. So having a robust Gen AI strategy is one of the most paramount things. Second, performance and the way it is measured and how robust that is, blended with insights, will always remain a key enabler for a good HR system. Third, making sure that the data architecture and having center of excellence teams which can roll out learning and development is again a big important area. With this new skill of Gen AI, strategic workforce planning has become paramount. And lastly, having an agile org helps organizations reskill, upskill faster. With that context for 2 minutes, I'll just start off with the panel discussion itself. I'll start right at the fag end with Govind. Govind, when you were designing Utkarsh and everything around it, I just wanted to understand two facets of it. How do you think of organizing the HR function when you create an organization like Utkarsh, especially when you are creating a smaller or a newer organization? How did you go about that?
Yeah. So I think, thank you very much for having me here. So when you look at any organization, I think it goes through different phases like any other thing. So if you look from the HR angle also, when we are startup, I'm talking 15 years back, thought process is completely different, getting some people, organizing things, having basic policies in process, policies and process in place, and get going. What could be important is, your policies, processes, SOPs are in place. That is what you try to keep on day one. You are able to have, properly trained people who go to field because they are the brand ambassador for you. They are the people who will go to field. I'm talking generally, how HR looks at. But the moment you run into scale and complexity of business also, because initially we are NBFC, MFI, yes. Then we converted to a bank. So I think the complexities of overall business, the complexities of the geographies, I think, makes a lot of changes, a lot of different ways of looking at things. So for example, use of more and more of use of technology is certainly there. But I still feel that, obviously the scale is very, very important. What type of scale you are talking about, what type of complexities you are talking of, what type of institution you are, trying to build, it is important. But the fundamental remains that, the edge factor is very, very important. Sometimes we go away from the edge factor. I think human factor remains the most important part for HR. I think too much of technology or too much of mechanization can have a challenge, the moment you look at this part. My sense is, historically also, conventionally also, and going forward also, I think getting good people and, and making them productive and helping them grow remains the fundamental for any HR. And that is what should happen. So whatever we are talking of, and the way we started this, it was a small institution, but whatever policy process were there, those are of a large institution. That is how we did it, but in a smaller scale. And they try to replicate that. As I mentioned, the only thing what changes in the whole process is when we have different product, different geographies, different complexities, you have to make adjustment and make changes accordingly. But fundamental of HR or fundamental of human beings remain the same. I'm not a hardcore HR expert, but as a HR manager, I always believe that the people belong to HR department, and they should devise the policies, and people are given in trust to the other department. That is how I believe, and that is what I have been running this institution for the last 15 years, and that will remain the fundamental. Use of technology certainly yes, but Hindi में बोलते हैं ना, मैं उसको Excel में खाना नहीं बना सकता. आदमी is not Excel का खाना. He has to be used as a human being only. That's very, very important for any organization. And that is what we have been doing from day one. Thank you.
From, you quite amazingly, you have set up a new HR organization 15 years. I'll move next to Kalyanji, who is running a bank, which is one of the oldest in the country. Sir, we have heard about how PNB has transformed the capability, the holistic capability building that you have undertaken. Now, given the constraints that public sector banks also operate, how should an organization think about developing in-house talent?
Yeah, thank you, Varun. First of all, thanks for this opportunity. The very good question. Actually, first from CEOs and senior management side, first we must think, what do we understand by HR? If we talk about HR, it comes in our mind simple support function like transfer, posting, promotions, all these things comes in our mind. And that too, if we talk about public sector bank and that too a large bank like Punjab National Bank dealing with 1 lakh plus employees and spread towards the length and breadth of the country, it is really a very challenging situation, and a lot of flexibilities are also, right Barun, you told, a lot of flexibilities are also not with us, like recruiting people, there is a structured process, and also for time-bound and some seniority-based promotion part, no incentivization. These are the restrictions of our being public sector bank. But beside that also, HR can play a very strategic role becoming business partner. So whatever I am going to speak, Barun, it will be out of my experience only, which actually really I have played important role in my earlier organization, Union Bank of India, that to a large bank, 80,000 plus employees. And currently at Punjab National Bank, which is actually 1 lakh plus employee base, and having more than 130 years of experience here, and that another organization also 100 plus years of its existence. Then actually, if we talk about this part of HR being a strategic business partner, so first of all, we must understand that how customer choice have undergone changes, how doing banking has undergone big change, big shift in there. Today, if I talk about skill sets, then those skill sets will be more technology-based, more, actually simply if I can say, more cross-functional team handling how to handle different divisions so that we can give some products in digital side or anything. Like vendor management also has become the skill set which we badly require now. So these are the area, just before this session, we are listening that AI is also transforming our overall process. Everywhere it is touching. So these skill sets are now important. So for that purpose at Punjab National Bank, what we did, actually complete life cycle of an employee we captured. From onboarding to means specialization stage, leadership stage. While we onboarded them, it is total 52-week grooming plan. It involves classroom and also on-the-job training. During these 52 weeks, the officer has understanding about the roles, responsibilities. They are aware about the basic facets of banking. Thereafter, 5th year, we provide them job family, so that at least within 4+4, there are 2 facets there. They get experience at least in 2 skilled areas. 9 job families we have categorized, looking to the requirement, IT, digital, credit, forex, whatever these are the areas. There they get specialization. And once they are having experience of 12 years, and we suppose that that time they reach to the level of assistant general manager, mid-management level, there we provide them leadership training program. At Punjab National Bank, previous year we provided 1,000 plus our leaders, AGM and above, this leadership training program. This is 1 year intensive program. First of all, we decided leadership competency model. In that leadership competency model, 10 traits we identify, which we require, that are required in the organization. HR is a serious business. If you really want to transform your organization, first we must understand what are the gap areas for this organization. And that too, Leader, actually they are role model to which kind of qualities, which kind of belief system, value system is triggering his behavior. So for leading self, 3 traits was there. And also for leading team, because in banking, no work in isolation you are doing, you are leading a team. So for team purpose also, which kind of traits you require, and also leading business or transformation, this is also important aspects of a leader. So they are also based upon these 10 traits. Psychometric test and 360-degree assessment was done, and based upon the outcome, individual development plan was created, and after that, the external faculty members were invited, and 2 days each for these 3 forums were conducted. And after one-on-one coaching also we provided to all these 1,000 officers, so that they can be handholded for being groomed into a good leader in the industry. Actually, Barun, I can tell in front of all these august audience, practically we have found a lot of synergy and collaboration and improvement in the production, productivity and also output. And the kind of struggle we are facing earlier, and we can see marked improvement in the performance also after implementation of this end-to-end transformation in HR. Another area which I told regarding lot of fintech, 60 plus fintech collaboration is going on currently with Punjab National Bank. So what we made, 50% team members from in-house and 50% are from vendor side. This gave them practical experience and also assisted us in capability building internally so that these transactions can taken it forward. I am very happy to share with you that our own in-house software development team has developed end-to-end straight-through process journey of PM Vishwakarma scheme that was launched in the hands of PM during this global FinTech festival on 30th August. So this has actually really the structured approach which we have taken. And it doesn't end here, even placements are also through tools. Those behavioral things, everything are being captured through digital tools, and those things are available with us. Because every year for job rotation, we are moving more than 20,000 people across the country. Now we are placing them as per their experience, as per their expertise. That also actually really providing them an opportunity to groom themselves in a particular area. And several things are there, skill assessment also we have done, and those skill sets are aligned with the respective job families. And in that way, very structured way, succession planning also is through tool-based. And in that succession planning, very targeted grooming plan is implemented, and for each critical role that we have identified, 40 plus critical role, 10-15 persons are being groomed to take charge of those things. So this I actually, in very brief, due to paucity of time, in brief I am telling you, whatever I have conveyed, actually it is a very strategic approach to make HR as a strategic business partner for any organization.
Thank you, sir. Thank you. Mr. Kumar, thank you. Mr. Kumar, look, I think last year you had mentioned about, this being your 4th innings in a way at RBL, and I must congratulate you for the amazing turnaround that you've had. And you had told us 2 data points, and I'll pick that. One, you said you managed to retain the core team. You hardly had anybody leaving at RBL when you had joined. I wanted to understand how did you leverage HR for this amazing transformation that the bank has gone through over the last couple of years?
Thank you very much. First of all, HR is no longer a task. HR has become a science. This is a big, important act which we have understood very clearly that the today's generation, when they walk into any organization today, they are coming with the yesteryear's generation's prerequisite training. Everybody takes away, and they come back with certain expectations. If your organization is not able to meet their expectations to that level, that's going to be the first dampener, right? So the HR resource, unless you are in a position to provide them an opportunity to growth and provide them the vision which is far away, maybe that one of the major decisions we took in the bank is that there is going to be first consolidation and stabilization Once you are in a position to reach that stage, then the growth path has been set forth. If you are able to show them where you are going to land, maybe in a year before, a year after, a couple of years after, and you know that where we are going to travel, they will be in a position to participate in the journey. The entire journey, the HR is an engine which is pulling, and technology is an engine which is pushing. The one important thing what this, the current employable lot looks at is whether the HR and technology are gel well. That is the most important thing they look at it. You can't come back and say that the basic hygiene today is providing them the laptop with your MS suit. It is not the question of having only the word. The days have gone. And the quick decision making and the hierarchical approach. See what today people are doing. You join to retire, you join to progress. If you are going to provide them the path for progress, they stay with you for long. If you try to say that you have just joined only for retirement and the current generation is looking for another hop. So you have to decide very clearly what sort of job role you're going to fit in. See, that is very, very important today. Be it a senior level or in middle management or a junior level, the moment the job role doesn't fit, there are guys who will walk out the next day. They are not waiting for your formal relieving letter or stuff like that, because we are also taking the people without formal letters also as far as his ability to match that role is being fit. It is like a soap opera, no? If you wanted to hire a hero, he must know the dialogue of the hero and then do according to that. Today's generation, which is Gen Z, very, very aspirational. If you are able to quench their aspirational appetite to 50+%, their probability of sticking on with you is very high. Right? If you are going to treat them like any other resource or an asset, your probability of retaining them is going to be pretty low. So this distinction, if you are able to bring it and then make it. And very important thing which today's generation looks at is continuous communication. Be it good, bad, ugly, that is a different issue. Second one, you must be communicating with them continuously. The days are gone where they look up the MD and say that, hi sir. So the question is, hi Mr. Kumar. To that extent, that is exactly what they try to say, right? You cannot take, no, yeah, I am, your age is much smaller than much lesser than my experience, then you have to look for alternative guy. So that's the way. It is not the younger generation or the current generation or a Gen Z or a millennial going to change. The leaders have to change to suit their ability. That is what exactly. If you want to retain them, you have to change your role. That's what is...
No, thank you so much. I think, sir, you touched on 4 things. People, technology being in unison, matching the expectation, Gen Z, which I think you are clearly catering to in terms of employees, and then constant communication. Karnataka sir, I'll move to you now. When it comes to employee engagement, employee productivity, there are different ways HR is using technology. How do you think is best technology used in HR, and how is BOI thinking about leveraging HR technology in HR?
Yeah, thank you, Varun. Thanks for having me. See, HR and technology is something which is a very relevant piece today in the contemporary world. So if you see any organizations, there are 3 basic pillars, which normally we call in management the PPT, which is people, process, and the technology. So people is the most important part of that. So process and technology will only follow once the people is right over there. So if you see HR today, I would say that from the old times when the HR was more transactional, it has now gone into the transformational HR. So transactional HR was that when you have to just pay the salary, pay the bills, do the transfers, or if the promotion happens, give them a promotion letter. So it has now become totally transformational, wherein you have to reskill the people, upskill the people, like you have to choose the right job family for the officer who is posted over there. Once the job family is there and he is working in that seat, you have to see to it that the trainings are also correct. So it should not be that the person is sitting in recovery and he gets a training into, say, something about resource allocation or any other kind of thing. So it has become quite a bit scientific also in that way. So 3 basic pillars beyond that in the HR would be the performance management system at Bank of India, which we are seeing the 3 main parts. First part being the performance management system, second part being the learning and development, and third being making the technology at the hands of the employee through the web journeys or through the mobile app. on the HR side. So these are the three basic main pillars which we are trying to do in Bank of India for the HR side. So technology is the main pervasive thing. So any person who is joining new 23, 24 year, I just give you an example, a few Rajbhasha officers had joined our bank. I was addressing them and I was myself surprised when I asked them a question. It was only 15, 16 days of their joining and I was asked to address them. I just asked them, only 2 days ago they had got a salary. So Ajay, I just asked them, have you opened an account with Bank of India? Obviously they all had an account with Bank of India. Then I asked all these HR officer, Rajbhasha officers, that do you have a mobile banking? You will not believe all 17 had a mobile banking with them and they had started transacting. So that is the kind of engagement they have with technology now. So the more you have technology, not only in other things, but in HR also, the more the employee will be engaged, particularly the young age employee, up to the age of 35. So HR and technology, way to go. And just to give you more example, HR is not only HR, it is more business HR also now. So if more to give an example, so just an example I would give for Bank of India, more practical, is like we are having 10 lakh mudra accounts, which are standard, approximately 10 lakh. To give a calculation. So if you say that one officer does a renewal of a mudra in 1 hour, one account, so 8 hours he does eight accounts renewals in 1 day. So if you take 23 working days in a month, so it comes to around 200 mudra renewals in a month by one officer. So if you give an average salary of an officer, he can be a scale 1, scale 2, scale 3, whatever in the branch. So it is 1.5 lakh even if you give the salary. So the cost coming to the bank is 75 lakhs, 75 crores per annum to be exact. So that if you make it digital, this process of renewal of MSME digital, what you are making is that 70 crore one side you are saving, on the other side 5,000 man hours you are saving. You can use this as a HR for other purposes. Other purposes like maybe it can be marketing, it can be collection, or it can be sale of third-party products, or it can be any other thing other than the mundane task of renewal only, where bank is not earning because the account is already there. So these HR and IT go hand in hand. The more any organization gets into technology in HR, the more productive it will be for the employee. So there is one more data, interestingly, when you go around and read some of the HR researches and journals, that if the employee engagement is correct, the productivity improves. And if the employment engagement is not proper in the organization, any organization, the productivity gets reduced to as low as 10 to 12% of the employee. So that is the data which is prevalent in many of the researches globally. So employee engagement, productivity, and finally the motivation of the employee through technology. Today is the way to go.
Thank you so much, sir. Mr. Kamakodi, actually, you are the one who has been at the current organization the longest when I looked at the panel. And I remember you telling us about your story when you started at City Union 20 plus years ago. In your experience, while the bank has gone through a huge transformation, how has the role of HR changed from the day you had initiated to now when you are leading the bank? And how has it helped in the transformation of City Union?
Yeah, 20 years is a very long period in today's context. And coincidentally, when I joined the bank, I joined the HR department only. That was also coinciding with the centenary year of our bank. So we have, like say, PNB, which is immediate senior to us, started in 1895. Maybe before that, you had Allahabad Bank, which got merged, which was in 1870 or so. Maybe before that, 1803, you were State Bank of India. So we are in seniority, we are the third longest serving bank after SBI, PNB, and CUB. Why I say this is, like, when I joined, I mean, 20 years, I think, I'm not sure to what extent you will be in a position to appreciate. Probably Mr. Karnatak, Mr. Subramania Kumar can appreciate. So that was the period somewhere around 2003 when even the core banking implementation was under progress for almost all of us. So we had branches in rural areas which did not have connectivity, purely working on the ledgers. We had branches like what Mr. Kalyan Kumar said, like say about half of the branches which were working in the software which were prepared in-house by the in-house team. And the core banking was just like say, in the process of making. It was only 2004-5, the implementation of the core banking started. Why I say this is, in no time, whatever skill set the bank had earned over a period of 100 years, particularly in terms of frontline staff, particularly in transaction processing and all, almost it became of no value after the arrival of the core banking. You had to start the complete skills, reskilling of like making them to, like say, do the transactions in the, what you call, computerized environment. The public sector banks, they had just before that period when after the computerization, VRS schemes and all were given and a lot of people had left, but our bank decided that we will not have any, like say, VRS scheme at all. But fortunately, that also coincided with the liberalization of the branch licensing. So over the period of time, from 100 odd branches, whatever we had at that point of time, it increased to whatever 800 odd branches today, in a way. In that period, we had our, once again, the new people who entered were more tech savvy, the whatever skill sets we were able to give, and older generation also, they worked their best to, like say, update their skill sets and all. So it was a period like it almost took us a decade to go for that complete generational transformation without like say tilting whatever you have. Probably the RBL bank also, if you look into the case, they faced like in transformation from a old generation bank to new generation. But the bank was much smaller, so the assimilation in making the RBL bigger and all were, I mean, if you read the numbers and all, it was very, probably the, I mean, not as difficult as people like us. We were almost a dozen bank which were under this category. So we, that had actually like, but good that the system responded. So, okay, we took us, we were like say some extra time in changing that thing. So we were able to have the right mix of the older skill sets, particularly in terms of, like just to add to what Sir said, the new generation, now it is more comfortable in looking into the mobile phone rather than meeting with the people. So particularly in a branch, particularly when you have footfall, you need a generation of people to teach them that how to handle people. In fact, one small incident happened, probably which will give you an idea of magnitude of the problem. One day I received a letter written by hand, a shaky handwriting, not less than 25 pages, and you are not going to read a 25-page letter. So when somebody with a shaky handwriting, it was very clear that it was a very senior citizen, writing a 25-page letter means something big has happened. So I then immediately called the inspection department and gave, kuch to problem hai, you just look into. Finally, when we got into the problem, the source of the problem was that my young frontline staff gave the cash to a senior citizen with the left hand. This was the problem. This is the origin of the problem, which created the big issue. Then we called that staff member to ask, kya kiya aapne? So she couldn't understand what was the problem. Then we asked, why did you give with the left hand? So what was the problem? So he was standing on my left hand side, so I gave. There was no other explanation. Unfortunately, probably at our home, nobody has thought that giving something with the left hand is disrespectful or whatever it is, which we normally expect these sort of things, sanskars will come one generation after the other, which was not there. So even from these sort of issues, we have to include in the training so that the subsequent generation of the people, at least they get, apart from, like say, technology issues, now technology people learn even with a, what you call, self-learning kit, people are prepared to understand that. But now you hear almost more than 2/3 of your deposits is from senior citizens. Their expectations are different. So making the younger generation people to meet their requirement and all, the reskilling has to happen not only on the technology side, but also on the softer aspect and how to deal with the people. But so far the system has responded and taking things forward. Yeah.
Thank you. I think you touched on a very important point which often gets ignored Mr. Kamod, which is reskilling, not in terms of hard skills, but softer skills. I'll move from the third oldest bank to the newest one, I guess. So Indrajit, you had, I would say, both the luxury also, but the challenge of building almost an HR department from scratch in a very recent and a very short time frame and in a challenging environment. How have you leveraged, when you got a slightly cleaner slate, how have you leveraged technology to build the right HR function, and what has been the impact?
Thanks, Varun. Like Varun alluded, Unity Bank is the youngest bank in India. We are just 2 years old, having received the latest license from the Reserve Bank. We had a very interesting launch into banking. We took over a bank which had fair amount of complexities and older staff by age. But I knew the day we put a hand into this, that has to be a strength. I'm happy to tell you, we have had almost no attrition from that cohort of 1,200 people, which came into Unity Bank. And that was simply by respect. We respected their banking knowledge, we respected their customer service, and the sanskar which my esteemed colleague has talked about. But having said that, I can't be the youngest bank in India and thrive on just experience. We have aggressively gone and hired people in the age bracket 25, 28 to bring down the average age in the bank to 32. The next 4,000 people have been below 30, which means that we had to basically enforce an amazing HR ethos, HR spirit, and HR systems into our network. I'm an IITian by profession, so I said AI, that will help us. Conventional modes will not help us expand the way we have been doing. So from day one on our hiring, our engine has been AI driven. It helps us give a score number on every resume we get. We get a software score number on the resumes we get. And based on the need, then we start evaluating. It's an open secret. It has helped us. We use AI for our training programs. Banking is not rocket science. Banking has been the way it has been for the longest of time. We've managed to encode it into programs which are compulsory, and programs which are optional, and programs which are aspirational. So all cohorts of our staff go through them, and we have a reward mechanism in place for people who do more training than is required in the basic skill sets. But at this stage, Varun, I must tell everyone a story. You know, I picked up in the airport one book, and it said, The Coming Wave, AI, is written by Microsoft head of AI, Mustafa Suleyman. I said, ye theek lag raha hai. I will read this in the aircraft. So taking off from Bombay, long aircraft somewhere, I read the first 18 pages, I think. I said, awesome. What command of English, what grasp. This Mustafa Suleyman writes very well. I was captured in the book. First chapter over, there's a blank page. Second chapter, and the author writes, I haven't written the first chapter. That was AI. Here on, I start writing. Please bear with me. So that is the age in which our generation is living. Before I hand back to Varun, what I want you to know is the two challenges I'm facing and I'm not being able to solve yet is the gender diversity in my bank. I don't have enough women on the top. Really. And we have really tried. I have personally told HR that we will not evaluate a position till you also show us a woman candidate. With that, we are trying to right size it. I think at the branch level, we are 50-50, but in the leadership, we are nowhere close. Can I request the young women here to please go for it? I think all banks, and I'm sure I speak for Govind also, we will be delighted to have better diversity, better gender mix in our boardrooms and our leadership teams. Thank you.
Thank you. Thank you so much for touching on that gender diversity point. I think it's a point that is well understood, but as you rightly said, at the upper echelons, the numbers still don't reflect the efforts which are being made at the ground level. Govind, I'll circle back to you. You spoke about while HR is process and policies, but you said the human element never replaces. In your view, as you scale up the bank, and I know you have a bold ambition over the next 5 years to scale it up to a large bank, what is it that you want from your HR function? If you had to say, I want these 3 things from my HR function to help me scale the bank to where I want it to take in 5 years, what would they be?
Yeah. So as I mentioned, from very beginning or even conventionally, people, getting the right people, grooming them, making them productive, I think are the key function for HR. As I mentioned, for S factor is very important. So I think engagement part is very important. And especially, when we talk about the complexities, actually I want to congratulate Indrajit. If you have 50% women at your branches, that's commendable. I think we are struggling with 14-15%. I'll be honest about this. Especially we operate more in the Uttar Pradesh and Bihar type of territories. It is absolutely difficult to get even 20% plus. So if you are able to reach 50%, hats off to you. I mean, we obviously at the board level and at the senior level, it's an even bigger challenge. But the biggest thing for me remains the employee engagement part. I think gradually that is not the same what we used to be earlier. So what happens? The original HR requirement remains the same. It's not. It is changing. HR is if you think it is the oldest profession and oldest department for any institution. 200 years back also it was there. I think the things have changed because society is undergoing a change. The environment is undergoing a change. And that is reflecting, that is manifesting in all these things. So I'll just give an example. I think a lot of people give example. When I started in 2009, the new institution, so one of my unwritten policy was there, in case someone tells that I have an offer in hand, I'll not interview that person. Today I try to do that, I can't interview anyone. Because everyone which comes, I have 2 offers, sir. And the motivation for me to take him is, my notice period is shorter now. I don't require 90 days, I can join in 15 days time, I can join in 20 days time. So because of that, things have changed. So I think the most important part for me remains the employee engagement and the employee communication part. Actually, we all talk about employee communication, but the way we communicate, we are not we are transparent in our communication. I've seen that happening. The entire journey of onboarding or pre-onboarding is not seamless, in fact. So I think it's very important. The things have moved. And when I say environmental change, even as a consumer, today consumer talks of the experience actually. Same happens with employee also. 20 years back, employee was not talking, I need experience actually. But today you talk to the employee, he or she is looking experience, of the institution. So I think HR needs to work on that, and the employee engagement is the most important part. Second, where we miss a lot, and as an institution maybe here as well other places also, really assessing talent and grooming them accordingly. We have seen, we always talk, we'll do TNA, we'll do all this stuff, and after 3 months it is nowhere in fact. So doing all this on a regular basis, training people, grooming people and making them to next level instead of hiring people from outside. So I think grooming and talent, making talent important. Engagement is very, very important. And I think another part is, if my employees are free to, talk about, free to converse in the institution, I think creating an environment is very, very important. And that's why everyone is HR manager. It's not the HR department who is the HR manager. In fact, everyone understands in HR that people leave not because of company, more because of the bosses. So I think everyone in HR part, how to inculcate a culture where people talk about, people take care of the team, creating that environment. I think these 3 will be important things for me going forward also. I think because it's talking about more about technology, I still believe that technology is important, but technology is where we have repetitive job to be done. I'll use that where HR operations is involved, technology is welcome, we need that technology. But when we have to engage with the people, I think it's very important to have a heartward engagement with people. So that is how I look at HR.
Thank you. So
Thank you.
You said engagement, making sure that the grooming happens, and obviously then the communication part around it. One interesting anecdote, and some of you were there last year. We had a situation where tech talent was not available last year. And we had a question that was asked from the audience saying technology talent. We are today in a situation where we have so excess of technology.
Yes.
How the year has changed in 1 year. So just remembered from your offers example. Kalyan sir, I just wanted to ask you second, you had mentioned the entire journey in the first answer. You touched upon one point, sir, which was objective performance. When you took over the HR vertical, sir, and during the challenging time, how has that helped singularly when you think about PNB's journey over the last few years?
PNB was also one lot among the amalgamating banks. Oriental Bank of Commerce and United Bank of India got amalgamated into PNB. Exactly 3 years back when I joined this great organization, post-amalgamation issues were there, loss of market share, also brand value, lack of coordination, and also so many issues which normally happens and present in almost all the organization. Post-amalgamation, this was the scene. And things were changing very fast. To place Punjab National Bank in the league where actually all these aspects can be taken care of. The biggest threat, you told just now, you told about objective assessment of performance. In public sector bank, actually there is no incentive or disincentive for taking decision. Private sector bank is an exception. So first of all, in public sector bank also, we face that there is lack of clarity of roles also. We are having very competent persons pass through so many screening process that we recruit them. And very robust training system, grooming system is also there. But when they start working, for responsibility, only branch heads are responsible, or business unit heads are responsible, others don't have any direct responsibility. For that purpose, what we did, we actually, first of all, we created that each and every role officer must have clarity about their role. So first of all, the measurable role, branches persons or business unit functions, it can be done very easily. But for administrative offices, where measurability is not that much easy, so there also in the terms of TAT or in terms of handling the things, we also made them measurable. So each and every officers are having now measurable KRAs, key responsibility areas, and that too, if you are talking about 1 lakh plus officers, manually, it is impossible actually. So for that purpose, digital tool was created, and there was very good mechanism also that these things were, with discussion of branch heads, regional head, these things were getting fixed. Second important aspect in public sector bank, unrealistic target, and it was also prevalent, and looking to the potential, target setting was not there. So we also took care due to technology and several credit information companies, and all these things are part of this great ecosystem. We are having access to pin code level potential data. Now, this target setting is also very realistic, that yes, suppose any bank is growing to at X percentage and you are growing at X minus percent, then that target realistically looking to the potential, and also you can deploy resources also. Suppose potential is more, our growth is less, you can put in your resources also there in a very scientific way. The target setting realistic and role is clear. And thereafter, appraisal process, actually what used to happen, it used to happen in the year end. There was no trigger in the hands of employee or supervisor to provide them mirror that yes, your performance needs improvement. So for that purpose, we created PMS Profiler. In PMS Profiler, every monthly basis officer is getting a score. That yes, if I continue to perform in this way, then our performance appraisal score is going to be aligning with that. And one very beautiful dashboard is also there. One of my colleagues was speaking. MIS is very important for actually really monitoring and all. A very good dashboard is also there. In that way, we brought in the performance culture in the organization, the differentiation between performer and non-performer. But being public sector bank, we are having responsibility also to deal with this non-performance part in a very, very caring manner. And we try to find out what are the reasons behind this non-performance. Therefore, very important aspect of this transformation was capability building, which I captured during my earlier address to you. Very structured capability building and personalized grooming plan. In that dashboard, there is a provision that any employee can trigger that I want this kind of training program. And also, leadership board is also being created. Through that, looking to their grooming plan and succession planning approach, very personalized training plan can be recommended to those officers. And also AI-based chatbot and all these things are under development. Through that, because these days you all will agree with me, reading habit has got diminished, actually it has reduced a lot. So for that purpose, ready reference like ChatGPT kind of facility also we are developing, so that while meeting any customers, which kind of dialogue you should make, how you can make comparative analysis of products, so that truly HR can play a strategic business partner. In that way, bringing objective performance, providing them realistic target, and based upon that proper monitoring, and also hand-holding them properly so that they can actually really contribute a lot to the growth of the organization. Yeah, thank you.
Thank you, sir. Mr. Kumar, you spoke about 4 things in the last answer, and you touched about Gen Z, how you are managing the new generation. If you fast forward, what is your ambition from your HR function over the next few years? What would you want them to do over the next few years? You spoke about the 4 things, what worked till now. But what is it if I look ahead?
Mr. Kalyan talked about the challenges of the public sector. The challenges of the new age and private sector is slightly different from that. The biggest challenge is in attrition at the entry level. So the biggest, if I wanted to fast forward, if I wanted to move a couple of years ahead, how do I retain at least 60 to 70%? Because onboarding a person itself is a task. And HR would have spent substantial efforts in order to do that, and train them over a period and then make them to be, some of them are raw and they are made employable. When they leave, it's going to be, again the cycle is going to be hit. Although the HR may be efficient enough to fill the gap quickly, that is a different issue. But at the end of the day, the productivity takes a hit. So the first and foremost will be the how do I retain? There are multiple ways. See, today's generation, if you look at it, they want everything to be in the form of a capsule. Like they don't have a patience to look at your the CAM proposal which you want to make it for, which even if you're a chartered accountant, they're not interested to make it read it beyond 4 or 5 pages. My analyst is not ready to read the balance sheet. So I need to make use of a technology to help them do the analysis and then give them the inference part, leave it to them. That's going to be the big change which we're working on. The second important thing is that he is a little impatient. He or she is a little impatient in a sense that having used to the 2 minutes noodle, like they want that answer also to be a little faster. So in fact, there is a buddy concept. So in fact, my team has come out, digital team has come out with a in-house solution called RBL Buddy. Like it's very simple. If they meet a customer, they are not interested to know that what is interest. They will not be remembering it. They want somebody else to tell them. Since they are very quick at that, they are ungli masters, right? Their thumb are much faster than the feet and mind. So if you are able to provide that kind of solution, we have already done it to a great extent. If you just try to meet somebody and wanted to offer one of the product, then first natural will be the comparison. The product should be able to throw up right in the system itself, enabling him to do it. In fact, the success rate has been pretty huge. The very third important thing where we wanted to do them, the moment they walk in onboarded, they need to know when is going to be the next promotion. The growth path definition is something, it has not been in the paper, it has to be chalked out as a path. It's not a snake and ladder. It has to be a ladder without any snake. That is exactly what is being looked at. So you need to have that plan. So they need to say that climbing every step in the ladder is to be out of efforts. And if you are able to provide them the growth path, if you do X, you will reach the 4th stage. If you reach X plus Y plus Z, how you can go fast forward. They are not averse to competitive environment. They are ready to compete with others. But they need to know, if I run 100 meters race, where is going to be the tape where I am going to hit it? You cannot say endless running is not going to take them to 100 meters. You have to define that end path. So that's going to be some of this aspects we'll be working on.
I'm so happy to hear that you have such a deep understanding of Gen Z and what the characteristics they have about the thumb quickness, and I can see clearly that for your bank that's a very important segment. I'll move to Karnataka sir now. So actually you have seen how amazingly well public sector banks have turned around the fortune, and today they are at the cusp of competing with the best. If you had to fast forward, and since your bank, sir, actually has the largest international presence, if I think about public sector competing with private international banks, how do you think this HR function really will help you to make that leap of faith over the next few years?
Yeah, yes, Varun. Something very interesting, that is one part, like when we see the process, people and the technology. So people on one side and technology on one side. So there has to be a bridge which has to join the people and the technology. Because now banking is more of technology. So banking is technology, technology is banking, this kind of thing which has happened. So the bridge between the technology and the people working in a bank is the soft skills which are required. So this is something which is very important for any HR organization and the HR department, that soft skills are there. So end of the day, when you are dealing with people, it is the human approach which has to be there. Because unless and until it is there, you cannot take the entire team together. It brings me to a very, very simple analogy in which in this year, Roger Federer, one of the best tennis players, had given one lecture in one of the top management schools in US. I was listening to that, wherein he said that we are all aware that he is one of the greatest tennis players in the world. So where he said that when you have to win a Grand Slam, a tournament, you have to not only win the Grand Slam, but then you have to win each match. Within each match, you have to win each set. Within each set, you have to win each game. And then finally, you have to win each point. So it starts from the point, and then you finally win the Grand Slam tournament, maybe it is French Open, Australian Open, Wimbledon, or a US Open. So he said very categorically that each point is important to win a Grand Slam. Similarly, if I tell for Bank of India with 52,000 staff with us, so every person is important. This is what I tell my staff, that every person in the bank is important, all 52,000 of them, whether it is a sub-staff, whether it is a clerical or an officer. So you have to mark each of them. Through various technology process, you have to mark their productivity, you have to mark whether he's performing, if he's non-performing, how to bring him back to the system. So every person is important, and how to bring that person, to make that person feel important in the organization, that is the soft skill, which the HR should have. So that is the bridge between the people and the technology, which we have to build today. That is the crux of the matter. Whether other HR things, they are all part of that, the 360-degree review, when the employee joins, his training, whether his transfers, his positioning according to his job role, his job profile, and then his promotion, his taking care of the career growth. Part of that, if it's a female, then the maternity part, then all other kinds of things which are there. Now that is very important, that nearly 25 to 30% females in typically a public sector banks are females. You have to take care of their aspirations also. What are they looking for in the organization? And in the end, when they grow up and then finally they retire, you have to take care of their retirement things also, post their retirement, because now longevity is also there. So then again, that is part of the HR. So people and the technology and how to bridge it through the soft skill is something which is very important. Similarly, on the international part, there are totally different kind of challenges when our staff goes through international. So like if I give you Bank of India perspective, nearly 450 of our officers are working abroad, 450. So when the 450, the totally different challenges are there, different kinds of issues are there, because they are working in totally different geographies with different languages and different issues. So there even a different kind of skill set is required to handle them, to take care of them before they go there, once they are working over there for a period of 3 years as per the guidelines, and once they come back, some officer working in US or a London or a Paris coming back, and suddenly if you post him in a rural or semi-urban area, the entire the exposure and the experience goes for waste, not only for the organization but also for that person also. So all these things have to be taken together when you have to run the organization. And finally, the end of the day, I would say, Varun, that it is all teamwork. If you are able to take the team together, whether the person is working in a business vertical, support vertical, or a control vertical, if the team is going along well, the organization will automatically go well.
Thank you, sir. 450 is a big number, by the way, to have people posted outside India. I think you clearly have a different challenge. Mr. Kamakodi, by the way, very happy to know that you started your career in HR and you spoke about the 20-year journey and the importance of teaching culture. Sir, what will sustain City Union Bank for the next 100 years from an HR perspective? You keep talking about, you keep talking about 120 and the third oldest, right? And you said the thing that has worked is the culture and the customer connect, and how now you're managing the dichotomy of having younger people in branches versus the older customers. What is it that will sustain this?
See, just to take a slip from what Mr. Karnataka has said, from what he listened from Mr. Federer's point, how each and every, person is important in the organization. One important factor, probably the new generation, both youngsters and also the banks may not be in a position to appreciate. Our bank take pride in saying that in 120 years, the bank did not lose even a single day because of the employee unrest or strike or shutdown or whatever. So how it got sustained for this 120 years? Basically, it is the way how you have a balanced approach to all stakeholders, be it customers, be it regulators, be it the shareholders, be it employees. So each and every stakeholder has to be treated with whatever respect and whatever importance you need to give. So if any organization for that matter, if it takes care of the different stakeholders with whatever, respect that needs to be given, the sustainability, be it regulator, the sustainability actually comes into. So we, I can't, another 100 years or whatever it is, the fundament, this is the, you can extrapolate to any length of the timeline. The basic, the point is that how you take care of every stakeholder who is, making a bank. That's the point.
Indrajit, you started off explaining the bank's background, and thank you for that context. If you have to advise some other colleague of yours about how do you reskill the workforce, how do you upskill the workforce, how would you do that?
Yeah, I think, Varun, even in last year's FIBAC HR panel, we had concluded that skills is the biggest gap which India faces. I think it's more true than ever today. I shared with you that when I started the bank, I knew I needed younger workforce. So we went to the colleges. We went to the management institutes. And as all of us know, the girls, our children, sisters, do much better in academics than the boys do. So you go into the colleges, you can recruit a very intelligent cohort of young people, boys and girls. And we made sure that we recruited equally at 50% level, almost to the number. Then we had this large task of converting youth who were trained, who knew their balance sheet, who knew their finance, who knew their numbers, into banking and customer service. That's where HR came in. So we used, a kind of a platform called Talent Guard. Who all have heard of Talent Guard here? It's an AI HR platform for training. We got this straight out of Eastern Europe, and we put it into our systems. So there was first few weeks of handheld training, followed by self-training, and then they hit the ground in the different branches. Each youth, each person was mentored by an older person who knew banking well. With that mix, Varun, we managed to skill our new recruits into banking. The elders were already experts, but we now had a gap in the middle. We had 25-year-olds who understood customer service and banking. We had 40+ who understood banking inside out. But now we needed the energy. We needed the charge to actually grow the bank in the path we wanted. That's when we went to our peer group banks. From our peer group banks, the only thing we offered was, we can't offer more money. We really can't. Actually, no bank can offer more money. There's always somebody else who can offer more. So what you have to offer is content of job. Each person will be responsible and know that she is responsible to deliver something in her role. The moment the person has that satisfaction of knowing that what I do today translates into this business today, he or she will never leave you. People don't leave for money. People don't exit for money. They exit bad bosses, they exit bad culture. Make sure your culture is vibrant, inclusive. Make sure your people are given roles which matter. Almost to the extent of them knowing कि कल मैं ऑफिस ना गई, ये कौन करेगा? मुझे ही तो जाना है ये करने के लिए. That ownership, that absolute love for job is required. I'm a very small bank, just a few thousand of us. I can still sustain it. I can see challenges as we grow bigger. But आज AI आया है हमको मदद करने के लिए. 5 years later, something else will come to help us. I think we will sustain. We will do well.
Thank you, and we all hope you do. We are almost at time, so I'll just take one question, one or two questions if there are any in the audience. It's quite late in the day, so yeah. If somebody can please pass the mic to the gentleman there.
Hi, am I audible? Yes. Sure. Hi, my name is Deepak Bhatia, and we are from QuickWork. We work with Indra sir, so thank you so much for having us as a tech partner. The challenge which we have been seeing is that while we have been trying to automate a lot of HR processes, the budgets for the HR team is a major constraint, right? So while I do hear all the MDs and CEOs talking about culture and technology, I rarely see the combination of HR and tech team coming together and deciding how to use tech and HR. So is there something which you all have initiated in your organization to ensure that HR becomes tech-enabled, both in terms of the 7 stages of life and also futuristic roadmap for the organization? Thank you.
Indrajit, if I may ask you to answer, because you're the one who's invested most in this.
Definitely. The question asked was budget and how do we allocate it? It's very simple. The largest budget for a service industry company like ours, all of us on the panel here, is HR, is people. But we don't put our budget in HR head. That's my bank. We charge it back to businesses 100%, and HR is a neutral center. So all the costs of HR do not stay in HR at all. So no one can accuse HR of being a cost center. Whatever HR spends is for business, and in that allocation, we charge it out to businesses. So end of the year, HR is sum zero game. By that, what do we achieve? First, we achieve respect for HR. that they are not a cost center, they are absolutely a business center for us. Second, we treat HR not as a kind of a excluded cohort, but they are all HRRMs, Human Resource Relationship Management. So they are part of business. They sit with us on our floors, they go out on calls with us at times, and we've managed to integrate HR in a way of life, not to think of HR as adversary, but absolutely part of the business to grow with us.
Thanks, Aditi.
Thank you. Thank you.
I've been already, yeah, okay. One last thing, maybe, yeah.
Good evening. I want to share something from our experiences working with Gen Z. I think Mr. Kumar talked about Gen Z, and all of you, the panel, I must compliment, you talked a lot about Gen Z. Our company works with frontline workforce. We hire, train 500,000 people. On an average, we meet 1 million people across the country, across India. So one of the questions we asked is, what does the Gen Z want from HR? You're asking what CEO wants from HR. We asked the reverse question. What do you want from them? You'd be surprised some of the interesting things they said. They said, we don't want employee engagement. We don't want any of them, but we want to win in the first job. The biggest challenge for frontline people is self-esteem. And today, the attrition rates in private sector banks are very high. Many of us know that. I think RBI has also flagged it. If an employee loses his first job, he goes in a reverse trajectory in life. So the most important thing HR has to do is to make sure people win in the first job. To win in the first job, you have to set the target correct. You need to create the incentive system right. And most importantly, and I think this is what they said, we don't want company induction, we won't want product induction, we want role mastery induction. We want to master the role. Can you tell us which are the critical tasks in the role? How do we master those things? Because we want to win. So my submission to this group also to think deeply about how do we make, what design of organization are we building, HR side, CEO side, to make them win. Thank you.
Yeah, it's a very good feedback which has come. So I'll just take it in a different way, Varun. So if an employee joins today at 24 and he has a retirement age typically in a public sector at 60, so he has 36 years of service. So today in 2024 when we are talking, the generation shift is happening every 7 years. This is the kind of fast social media world which is there, digital and the social media. Earlier the generation shift used to happen in 15 years, maybe 10 years. Now the data shows that it is 7 years. So what it means in 36 years, you are serving 7 generations in a bank. In an organization, there are 7 generations serving in a bank. As gentleman rightly said that Gen Z, so this is one generation which is there in the organizations, like which are aged between 24 to 31 typically. Another generation is between 31 to 38. Another generation is from 38 to 45. Another is 45 to 52, and then another is 50. So you have to take care of all these 5 generations in a bank. So if a HR policy is typically made for all the employees, all officers, so it will lead nowhere. It has to cater to each part of the generation which is there in the bank, because each generation has different goals, different aspirations from the organizations. So I think that would be a better way of handling the things.
Thank you. Mr. Kumar? No? Thank you, sir, for that.
See, as has been rightly flagged by a gentleman from the industry, the first-time job seeker is not looking for the fat purse. He is looking for one important thing: what is going to be my future exactly 1 decade ahead. Do I have an opportunity to move up in the ladder in this organization or not? So the simple model which I've just introduced in the bank is 30, 60, 90. Very simple. First 30 days, don't burden him with any target. Normally what happens in the attrition, one of the reasons what I found is that, so most of these people just come down. First day they say that, get us 10,000 accounts, your minimum account of this quality account, that, XYZ, and all those things, that fellow gets into the literally withdrawn mode. First experience for a person to get into that any organization is onboarding. The day on which he walks in, does he get his ID? Does he get his badge? That is, get his laptop? Does he get his all the paraphernalia? We have a kit of 1,000 rupees which is given to everybody who is just onboarding. If it is given to him on the first day, he gets attached to that brand, number one. That's the first win if you wanted to succeed in the journey of interaction and reduction of the attrition. Attrition cannot be removed, it is going to be reduced. If not 40, it may be 30, if not 30, it may be 25. The second important thing is next 30 days, he has to be inducted into the role or his aspirational role. I'll put it this way. It is not the role. First, we have to have an HR business partners who engage with him for a couple of days to understand that whether he has come into the right role or not. See, normally what happened? No, first, they were all interested in the campus. They want to get some job. Okay, this is my first job, I got it. Next 3-4 days, they're able to make clear, I don't think I'll fit in, because today's generation, I have to give all the credit to them. The transparency and the fairness is extremely high than to the date on which they joined. Way back in 1980, if you call it, just waiting for a job. If you got it, you changed ourselves. We retrofitted ourselves into the job rather than making the job to fit into my liking. That's a big change. If you are able to make that assessment in the first 1 week, there are engagement and disengagement has to be decided. If you don't decide that engagement or disengagement in the first 7 days of the onboarding of an individual, possibly we are going to have a higher attrition. The next 23 days, moment you know that the engagement is going to be there, then put him on the rhythm of the organization culture. See, the culture is not something which is going to be learned over a period. He has to be talked about where to look for what. He is very simple. You don't have to teach him. You don't have to lift the spoon and then put it in his mouth. Right? You have to simply tell him where to reach for what and put him on the rhythm of it. Today's guys are very fast in understanding things and their grasping power is fairly high. Put him on a rhythm of 30 days. 30 days, by 31st day, have again another interaction. That is a re-engagement interaction where you have to decide, I've just put you, I've paid no salary, nothing, this is what you expected. Have you boarded the train? Because 30 days is an important thing. Have you boarded the train? Have you occupied your chair? Are you in a position to proceed further in this journey of the next station? If he says yes to it, disengagement has to take place at that stage. If suppose you find it, because most of these people are very frank and say that, so 30 days things have come. But somehow this banking stuff and all, I don't understand. What is this negotiable instrument act? What is this cross-selling? I mean, they just get into that. I am a pure sales guy, I fit in. I'm not a sales guy, I'm a credit analyst, I fit in. I don't fit into this if you can give me an alternative role. That is a re-engagement role. You have to find out whether he fits into that role or should I have a role change. If I have a role change, my engagement with is going to be for the journey till the destination is reached. If I don't exceed in that 31st day, then again, if he's done, next 30 days is very crucial. You need to have a buddy program. You can't ask the guy to get onto that with that, with the tie and shoe, this, and then go get into the market. Possibly he will lost in the jungle. So you need to have a buddy program wherein he has to tag along with somebody else. So 61st day will be the crucial turning point between him and the organization. That day will decide whether he is going to take that on his shoulders and is going to walk out, and he is not going to off-shoulder it and then walk out. So this is exactly the decision day. That day you have to say, if it is off-shouldering his walk out, have a good farewell, give a bouquet, and then say salute and then move on. Otherwise, next 30 days is going to be the contributory day. And 91st day will decide, yes, this guy is going to be part of my organization and my attrition is going to drop. This is easy said than done. First, making my HR to understand itself took me a lot of time. Having understood that HR, because I told it's a science. It's not something which is not going to be you can't have an Excel sheet to say that the 31st day tick box. Tick box, nothing. He can be, you know pretty well that the pandemic taught us how to be silent in the VC and not to participate. Thanks to that VC media, no? Everybody will be wide awake, but nothing registers here, everything fly out. So you also know that he's sitting before the video. So these first 7 days, 31st day, 61st day, 91st day will decide this engagement. If you are able to hook on scientifically well in organization, attrition will drop like a dead wood.
Thank you so much, sir. With that, I just want to thank all the panelists for joining us and sharing very nice anecdotes and examples about it. I hope all of you took away certain insights from them, from their HR experience. Thank you.
Thank you very much.
Thank you all dignitaries. Ladies and gentlemen, I would like to inform you all that a networking reception has been arranged at the food staging area next to this hall. Looking forward to meeting you all again tomorrow morning at 9:30. Have a wonderful evening.